Romaine, Bostick here alongside Katie Greifeld. This is The Close here in a wide-ranging interview there with the Treasury Secretary, Katie Greifeld, where she talked a lot about the state of the economic conditions, but more importantly, the state of fiscal policy. And in her words, the need to make sure that fiscal policy remains in check. She said that a bigger fiscal challenge right now will be there if the rate path does stay higher. But she said it is up to those fiscal policy makers to make sure that they adjust to that. She also talked about globalization and trade and said that while there is a pullback in globalization, she does not want to forego those benefits, referring once again to the friendshoring narrative that she has been espousing. And she started off this interview talking about the recent rise in rates, saying that the underlying trends of a low rate era are still there. Michael McKee standing by right now, our Bloomberg International Economics and Policy correspondent, who is listening in to that interview. And let's start off with her comments on Treasury rates and Treasury yields and the idea, in her words, Mike, that that recent rise in yields on the longer end is a reflection of a strong U.S. economy.
Yeah, I think that's the part that Wall Street will pay the most attention to. She doesn't think it's really the fiscal deficit that's pushing up long-term yields. She noted it's a global phenomenon. Yields are rising everywhere. And it's the resilience of the global economy. And in the United States, particularly the resilience of the U.S. economy that is pushing rates higher, which raised the question then of will rates stay higher for longer. And as you point out, she said she didn't think so, that going into the pandemic, we had seen rates falling for decades, and that demographics suggest that they will continue to fall and that we probably will have lower rates going forward, although nobody can tell right now.
Michael McKee down in our Washington bureau, a closer analysis there of the commentary we heard out of the Treasury Secretary just a few moments ago. Meanwhile, back here at Studio 2 at our New York headquarters, Saira Malik is joining us, pleased to say, Chief Investment Officer over at Nuveen. And Saira, you had a chance to hear some of the comments, and I want to start off with her comments about the moves that we've seen in yields. The idea that that is connected, in her words, to a strong U.S. economy. But I thought it was interesting. She still talked about the underlying trends of a low-rate era are still there. And I guess for somebody with 50 years of experience, I guess she has the perspective to understand that 5% is far from the heights that we saw maybe 2 or 3 decades ago.
Markets are focused on 3 issues right now, and that's yields, earnings, and geopolitical issues. When it comes to yields, with 10-year treasuries at crossing 5% earlier this week, it might be doing the Fed's job for them in terms of tightening monetary conditions. There's about a 0% chance of a rate hike next week when the FOMC meets, and probably still a good chance of a rate hike in December. So going into next year, we're seeing no rate cuts in the first half of 2024, perhaps some cuts in the second half of 2024. What's been carrying this economy has been the consumer and the strength of the consumer, but our concerns are that the consumer is showing some cracks in terms of auto and credit card delinquencies. So the economy is slowing, and these yields are doing some of the job for the Fed.
Let's talk a little bit about the consumer, and for that matter, really all of the pillars of spending right now that are supposed to support the economy. We're in earnings season. A lot of the companies we have aren't necessarily directly consumer-facing, but we've kind of got a taste of it. And there's certainly not the same level of growth out there, though profitability is still there for a lot of these companies here. What we've learned so far, does that bode well or ill for what we're going to learn over the next 2 weeks?
Well, we're seeing strong consumer numbers in the GDP data, and probably we'll see that again tomorrow in PCE numbers. But listening to Meta and listening to Alphabet, they're talking about an advertising slowdown. They are worried about the consumer. So I think the consumer is an issue, and that has been the crux of what has been carrying this economy, including employment markets. So if you see the consumer slow, employment markets may likely follow that, and that is where you finally get to that mild recession likely in 2024.
Can we talk a little bit more about earnings here? Because it's been kind of shocking to watch the reaction to some of these reports. Obviously, Alphabet having its worst day since March 2020. Yesterday, you look at Meta shares today off by about 4%. I know there were some misses in here, but it just feels like this is a very punishing market right now.
Tech earnings have been a challenge, and we're going to get Amazon after the close. The question is going to be around their cloud business. If it can grow at rates or higher than what it grew last quarter, so that would be about 12-13% or faster, I think the market will like it. If their cloud business grows slower than that, then what we're going to hear is that Microsoft is taking share from everybody, not just Alphabet, and that'll be positive for Microsoft, but not good for the other tech stocks. I think Meta is a cheap stock, but they are signaling, just like Alphabet, that they're cyclical and advertising is slowing, so that's mixed for those technology companies. And today you're seeing the S&P fall below its May lows of about 41.54. That's not good technically for the markets either.
All right, so 2 hours to go. Our hands are in Amazon. Let's also talk about oil, because I see in your notes you talk about the short-term risk of higher oil prices, but then you take a look at oil, and the slide has been kind of quiet, but very pronounced. I mean, I feel like a few weeks ago we were talking about potentially 100 barrels a dollar per barrel, and now we're taking a look below $84 per barrel. What do you make of the slide in oil, and is that sustainable?
Oil prices are very dependent on these unfortunate geopolitical issues that are happening. Supply is tight for energy. What you're seeing is the markets move into a fairly defensive position on Fridays, going into the weekend with concerns that this Middle East violence will escalate. And then Monday, the market re-looks at all of this. I think with oil in such tight supply, any impact on supply for oil could shoot oil prices over to above 100. And it has happened in the past where this has tilted us into a global recession. So that is a risk that is out there. It's not the base case right now, but it is looming out there and making the markets nervous.
Saira, great to talk to you. Great to have you here in
Thanks for
studio.
having me.
Saira Malik in town, Nuveen, Chief Investment Officer, helping to kick us off to the close here on this Thursday afternoon. A jam-packed show bursting from the seams, including a conversation with Morgan Stanley CEO James Gorman and his chosen successor, Ted Pick. We're going to get insight as to what the future holds for Morgan Stanley.
Plus, Silver Lake says it's working on an offer to buy Endeavor Group. We'll talk it through with Jason Bazinet, who covers Endeavor over at Citi.
And a closer look at the travel sector. Royal Caribbean out with its latest results. The CFO, Naftali, Holtz, going to be stopping by the program to talk about the health of his company and the travel sector writ large. All that and more coming up in a bit. This is The Close on Bloomberg. All right, James Gorman over at Morgan Stanley told us 5 months ago that he would be stepping down as CEO. He did not say at that time who would replace him. We now know who that is going to be. Ted Pick, the co-president over there at Morgan Stanley, has been selected to succeed Gorman. Gorman telling us that he feels that right about this potential change. Janali Bassick had a chance to sit down both with Gorman and Pick earlier today at the firm's offices in New York. Let's take a listen.
I personally think the U.S. has dodged a recession. I think the Fed is very close to being final, within probably 25 basis points. We're starting to see activity. Look at the Chevron deal we just announced the other day. I mean, phenomenal. So we're seeing activity in different sectors. It's coming alive. Now, so no, I think the next couple of years will be great. But what I care about is over the really long run. When we set about on this journey, we weren't focused on a quarter. And if the stock takes a dip in a quarter, I say that's kind of good news because we're buying back stock. And every share you buy back, you're retiring a dividend. So shareholders who hang tough are getting a 4.5% yield, and we're buying back stock, and the stock's cheap. So it's kind of a good situation to be in. But medium term, no, I think the firm is going to do great.
Ted, what are the biggest challenges for you as you navigate this environment?
There's just so much opportunity. We're definitely in a new paradigm. Interest rates are going to be higher for longer, and the world's gotten smaller, which means the clients need advice. They need in the wealth and asset management space. They need in the institutional space, our corporate clients, and we're going to have lots of activity around those clients. So I just want to make sure that we are completely aligned in the business strategy we have in place. It's something that James has painstakingly put together for 14 years. The market knows what we want to do. So I'm incredibly optimistic over the next couple of years.
You've long been the #1 in equities trading. Lately, Goldman has surpassed Morgan Stanley in a couple of quarters, while JP Morgan and Goldman have been faring better in various forms of M&A and underwriting. Do you have a plan to be #1 again?
Listen, we have some great competitors, as you know, in the global investment bank, in equities and fixed income, and then across investment banking. We're focused on being #1. We want to have the right people in place. We've been investing for the next cycle. That next cycle is going to be investment banking led. And it means that in equities, we want to be 1 or 2 every quarter as we have been for the last decade. We have a fixed income business we restructured. It's now a top 5 business. And investment banking is going to lead the next cycle. There's going to be a lot of M&A consolidation. It's going to be across industry groups. The world's gotten smaller. There's a new cost of capital. We want to be a leader, a global leader in all those spaces.
Ted Pick speaking there, and that is the new pick to be CEO of Morgan Stanley, with James Gorman set to depart at some point in the near future. The announcement coming just a couple of days after our next guest actually downgraded the stock to hold from buy, saying that there were a lot of questions right now about leadership and the transition ahead. Dick Bove, pleased to say, is joining us, Chief Financial Strategist over at Odeon Capital Group. And Dick, I'm looking at that note that you put out about 3 days ago here. I'm just going to quote you. You said, there is no clear leadership and there is no clear direction. Now that we have an announcement about who is going to succeed Gorman, do you feel a little bit more comfortable about the direction Morgan Stanley is going?
Yes, I do. I wrote that because I was getting really frustrated over the fact that they had not announced who the new CEO would be, what the new structure would be in terms of management, because to me, it's inconceivable that a company can go 5 months without indicating who the new CEO is going to be. That's something that every board of directors should have figured out, 2, 3, 4 years ago. And if the CEO steps aside, the new CEO should step in place. And the reason why we need to know who the CEO is because the CEO is going to set the if you will, tone of where the company is going to go in the future. And without knowing who the CEO is, we don't know where this company is going to be going in the future. My belief is that the selection of Ted Pick was the best of the three, because based upon where I see the economy shaping, the financial system shaping going forward, I would agree 1,000% with what Ted Pick just said. I believe that the banking industry is going to contract, as a percentage of, well, it has been contracting for a decade, but it's going to continue to contract a little bit faster as a percentage of total financial, if you will, transactions, and that investment banking is going to become significantly more important and significantly more attractive. And therefore, I think they've picked the right guy. I think the guy has got the right outlook for where the company's going. So I would say that, a lot of what I was concerned about is starting to get clarified.
And you touched on what I've been wondering about. Of course, Gorman was transformational at Morgan Stanley. Ted Pick finally in the seat. But are we expecting any big strategy shifts under Ted Pick, or is this more about keeping the ship on the track it's on?
No, I hope there are going to be major transformational shifts, because think about it. In the period from 2019 to 2022, the money supply in the United States grew by 50%, $7.5 trillion, right? That has never happened before in terms of percentages, or it may have happened in World War II, but it's not happened in terms of percentages. It's not happened, obviously, in terms of absolute amounts. Well, what does that do for asset management business? It lifts it dramatically. In other words, Morgan Stanley has had the right strategy in the best of all possible environments for that business. Now what's happened in the last year and a half, the Federal Reserve has shrunk its balance sheet by slightly over $1 trillion. The money supply is down $1.25 trillion, and it's now actually shrinking. It's down 3.5%, not up 26%. So I don't think that wealth and asset management is where you want to drive this company. I think you want to drive this company in the direction of, allocation of funds within financial groups. And I think that if they don't make a transformational change, I'll be very, very disappointed.
Dick, up against the clock. Got to leave it there. Hope to have you back soon. Appreciate your time today. Our thanks to Dick Bove. He is Chief Financial Strategist over at Odeon Capital Group. Now coming up, Silver Lake says it's working on an offer to buy Endeavor Group. We'll speak with Jason Bazinet over at Citi next. This is The Close on Bloomberg.
Shares of Endeavor Group soaring today, up more than 20%. This after Silver Lake Management, which has a controlling interest in the company, said it's considering a takeover bid to take Endeavor private again. Remember, Endeavor is the company behind World Wrestling Entertainment, Ultimate Fighting Championship, and don't forget the Professional Bull Riders League as well, and of course helmed by the ever colorful Ari Emanuel. A lot of questions, though, about why now and exactly what price. Jason Bazinet joining us over at Citi, who has a buy rating on Endeavor. And I want to start off first with the why now. now, because it was kind of interesting in the statement that was put out by Endeavor, which didn't specifically reference Silver Lake, just said they're exploring options. They seemed, Ari Emanuel seemed to express frustration about the share performance since they went public back in 2021.
Yeah, I mean, where does the frustration stem from? When it went public, this was very much a sum of the parts story. And while Endeavor continued to deliver on the numbers, the buy side got less comfortable with the sum of the parts framework and gravitated towards earnings multiples. And that put pressure on the shares. Then the company went through a second step to sort of unlock the sum of the parts value by taking half of UFC and essentially merging it with WWE to create the TKO ticker. And that was designed to sort of unlock the sum of the parts value. And the street didn't react to that either. I'll just give you one number. If you looked at the market cap and the closing prices yesterday, Endeavor has a market cap of about $8.3 billion. The 50% of TKO, which they own, is $7.1 billion. So it's the vast majority of the market cap. So the residual stub, meaning the representation business, the experiences business, had a market cap of a little over $1 billion. Why was that? What the street is essentially doing is they're not giving full credit for the 50% of TKO that's still owned by Endeavor. They're haircutting that, depending on the client we talk to, by 20%, 30%, 40%. And so I think the Endeavor folks are just incredibly frustrated because Endeavor does not come anywhere close to representing its actual value.
I am curious, though, if this is premature. I mean, when I first saw this, I think, okay, they went public in, spring of 2021. So we're only, 2.5 years removed from that here. Do you find it a bit premature that they would want to sort of go through the process of strategic options rather than maybe, I guess, just trying to work with the market for maybe a couple more years?
I do. What may give it a sense of urgency, and I have not heard this from clients, but I suspect that it could be true, is you have to remember that a lot of this is a people business, and a lot of the really valuable employees that work at Endeavor were told, hey, we're not going to pay you a lot of cash when we're a private company. We're going to give you equity, right? And just hang with us. One day we'll go public and you'll make a lot of money. And so they tried to go public once and it failed. They had to come back to the market and try and go public a second time. And so if you're an employee, you're sitting there looking at the value of the shares that you have in Endeavor, and they just have not performed well. So some of this may be a retention effort, right? At a minimum, to tell the street, hey, we're exploring strategic alternatives. That gets the share price up, at least temporarily, and at least makes the equity that the employees have worth more. If it ultimately does go private, at least it puts sort of the consideration more in the hands of the management team and not the marketplace. And so that may be another motivation. It's really an employee retention tool.
Interesting. I hadn't thought of that. And just to be clear here, Jason, when we talk about what exactly is on the table, at least based on what we know publicly from Silver Lake's comments, this would not include the TKO mashup that just went public?
That's exactly right. What they're contemplating doing, if they do something, is making an offer to take all of the assets other than the TKO assets private. So if something went through, what would end up happening as an Endeavor shareholder is you would still own 51% of TKO, and presumably you'd get a pile of cash from Silver Lake or some other buyer if it goes through. And then at some future date, presumably they would take the Endeavor entity that remains, which owns 51% of TKO, and publicly listed TKO, and put those together.
All right, Jason, really appreciate your time and your insight. Our thanks to Jason Bazinet over at Citi. And Romaine, I'm glad you got in the mention of the professional bull riders, because people always forget about them.
I didn't know you were a big fan, yeah.
I mean,
you are a horse person. I mean, so bulls aren't that far off,
they're
right?
kind of like horses if you scrunched them down,
slower
but also,
and like probably more powerful, a little meaner too.
I think I'd rather ride a horse.
I thought it was interesting too, the idea though too, because you kind of forget that they just basically say they're considering this, right? So you put the optionality on the table. The shares are up, having their best day since the IPO. They're up 20%. I guess if that upward valuation becomes a trend and it holds, then maybe you can take that optionality off the table and say, okay, now we remain public, now that all you fools finally have gotten it right.
Yeah, and it seems like shareholders are psyched at that prospect. Like you mentioned, a great day for those shares, not a great day for the market.
Is there a
overall.
professional horse riding association?
Many different types.
They are, really?
Yeah.
Okay.
I mean, I'm more
Can
in the
you
dressage
explain that?
world.
The dressage.
We'll do it in the break. This is the close.
This is the countdown to the close. Another day with equity markets on the back foot. Another day here with volatility in the Treasury space. Let's get a check on what's happening in the commodity world with our Abigail Doolittle and Commodities Close. Abigail.
So overall, we're looking at a decline for the Bloomberg Commodity Index. But it's interesting because we have a lot of commodities that are higher, but really weighing on the index. Crude oil, WTI, down 2.6% after doing a little bit of a reversal yesterday after inventory numbers came out that weren't necessarily supportive, but just some volatility, continued volatility in the market. Natural gas, on the other hand, a very solid gain here. This as stockpiles climb less than forecast. Wheat up 2.1%. Yesterday down about the same amount, so a little bit of a reversal there. And then orange juice up for a 6th day in a row, hitting another record high. This, of course, as disease and weather is putting fear, uncertainty into traders around supply. Now, relative to oil, we've been talking about the possibility of a big directional gain. We are very close to an all-out breakdown. If we go into the Bloomberg terminal, we will see that oil has been in this sideways range for quite some time, kind of going back and forth, and initially up about 40% from that low back here. But after the up and down, and we have this bounce back from the volatility when the Israel-Hamas war first started. And now investors, traders reassessing what is going to happen there. We have a bit of a breakdown here, Romaine. This is a bearish area of congestion. If below 81.50, we likely will go well below 80, maybe even towards 70.
All right, Abigail Doolittle there with a nice look at what's going on in the commodity space. Let's turn back to earnings and the travel sector. Royal Caribbean out with its latest results, boosting adjusted earnings per share guidance for the full year. Strong demand and, well, the ability to price trips accordingly. That's been the narrative for the cruise line sector, which as of late just seems unstoppable. Naftali Holtz is joining us right now. He's the chief financial officer at Royal Caribbean, joining us from Miami. And let's start off here with some of the numbers, particularly when it comes to the guidance going forward. I know there was a lot of concern amongst investors when you guys earlier had scrapped kind of that longer term outlook view on EBITDA. We looked at the forecast that you gave for the rest of the year, the forecast into 2024 here. What gave you the confidence behind those numbers?
Hi, first, good to be with you. As you mentioned, we announced earnings today at the standard quarter, really driven on a very strong demand environment. So we beat the quarter by 12%, and we raised our outlook for the year by another 8% on earnings. And really what's driving it is very strong demand for our cruises as well as onboard revenue. We just continue to see a very, very engaged customer that wants to seek their dream vacations with us. And combined with our strong cost controls and focus on profitability, that's really what's led to the increase for the guidance for the year. And the profitability, that's coming from more pricing power? It's coming from what? Yeah, so we've seen definitely for this quarter, our load factors, which is our occupancy, has gone better than we expected on already elevated expectations, especially in Europe. But really what really drove it was pricing, where we see customers willing to pay more for their cruises and experiences. And also when they get on board, they're just looking for their dream vacation. So they buy the extra internet package or the shore excursion or the dinner at the restaurant because they want to make sure that that's just the best vacation they took, and we're there to provide it. I want to bring this conversation about pricing power to what you're seeing in fuel prices. Of course, in your earnings, you included a $300 million fuel expense in the fourth quarter guidance. Should those fuel costs continue to march higher, do you have any plans to raise prices, or how would you combat that? Yeah, the way we manage it, obviously, we yield and revenue manage every day, and really looking at what the market is, and that's how we price our cruises. And we continue to manage our fuel expense. We are 55% hedged on fuel for the remaining of the year. Those are hedges that we put well before the prices rose. And really what we're focused on is to continue to be more efficient and reduce consumption on our ships. The newer ships are significantly more efficient on a fuel perspective. And just really our goals, not just for the bottom line, but also for the environment, is making sure that we continue to reduce the consumption. And of course, I don't need to tell you that interest rates are very high right now. So let's talk a little bit about your debt that you have coming due next year and in 2025. Are you planning on paying that down, or do you plan to tap the debt markets even in this higher interest rate environment? Yeah, so strengthening the balance sheet is a top priority for us. It's part of our kind of multi-year trifecta goal, which is part of it is to get back to the balance sheet we had pre-pandemic. And what we've seen this year is as performance has gotten much better. That means that, and margins got better. That means more generation of cash flow. And our disciplined capital allocation has allowed us actually to accelerate debt pay down. We expect this year to pay over $3.5 billion of debt. And we've also extended some of our credit facilities from next year to much longer than that. So we feel pretty good that with the cash generation that we have, we'll continue to pay down debt and obviously opportunistically refinance in the capital markets, just in our goal of improving the balance sheet and reducing the cost of debt.
We'll really appreciate your time. I'm sure is a very busy day. Our thanks to Naftali Holtz, the CFO of Royal Caribbean Group. Now still ahead, more on Ford striking a deal with the United Auto Workers just before they report third quarter results after the market close. Stay tuned. This is The Close on Bloomberg.
All right, time for a walk on the sell side with our top calls. Big movers on the back of analyst recommendations. Adobe up first, an upgrade to outperform. This over at Oppenheimer with the analyst there saying business momentum is allowing for, quote, durable growth, and says that 2024 outlook isn't so bad either. Adobe's generative AI offerings are right on the money, he says, and he also expects concern about penetration and pricing to dissipate. Shares, though, lower on the day. Next up, let's take a look at Live Nation, getting a raise to outperform. This over at Evercore ISI, with the analyst saying that now is the time to buy into the shares, making the case that the upside from consumer demand for concerts and live entertainment outweighs any uncertainty folks might have about 2024 growth, and says that DOJ investigation on Ticketmaster, remember that? No, he doesn't either. He says it doesn't pose any meaningful risk to the shares. Shares higher by about 0.7%. And finally, Hess, the oil and gas company, hit with a downgrade to neutral over at Susquehanna in the wake, of course, of that deal to be bought out by Chevron. He says it's highly unlikely that a competing offer will occur. Nevertheless, the shares down slightly on the day by 0.7%, and those are some of our top calls. We do want to stay in the sell side space here and take a closer look at the automotive sector. Of course, the big headline yesterday was that Ford and the United Auto Workers Union are pumping the brakes on that ongoing labor dispute, or reaching a tentative agreement. The automaker will hike hourly wages by 25%. The chart behind me that you're looking at, that shows the number of Ford sales per employee, which hit a record high last year, and that was a big part of the debate here in those negotiations. Ford also scheduled to report earnings after the bell later tonight. James Picariello joining us, senior automotive analyst at BNP Paribas Exane, and he's got an outperform rating on Ford shares. And James, let's start off first with the tentative agreement with the Auto Workers Union and Ford here. I know we had some sense that there had been a material impact from this roughly month-long strike here. Now that that has been resolved, is there any sort of clawback of, I guess, what investors had priced in terms of the negative downside?
Yeah, after 41 days of a strike, almost 17,000 Ford UAW employees out of plants. It's great. It'll be great for Ford to have these folks back working and have these plants back up and running in the next few weeks to months. In terms of the impact, right, for the third quarter, only 2 weeks. And one plant at the time, looking at probably about 100 million EBIT impact headwind to the third quarter, and rounding up all of the plants that have been down, and for the fourth quarter, we're still probably looking at about $1 billion EBIT hit to the fourth quarter for Ford with the strike now hopefully behind them.
It'll be interesting to see kind of the commentary later today out of the company, particularly when it comes to its future. And we know that future, at least for a while, seemed to be centered around electric vehicles. But I feel like over the last few weeks, they've kind of sort of tempered some of those expectations. And what's the balance that you're looking for between the legacy internal combustion vehicle sales and what they've been trying to do with the expansion of EVs?
Yeah, it is one of the critical debates right now, and we saw this from GM earlier this week, right? Walking back the EV, the intended EV ramp, right, so to speak, and really underscoring the flexibility in their production. Right, flexing EV production relative to demand, and Ford actually started talking about that last quarter, right? Really starting to emphasize and remind folks of their hybrid, right? Their hybrid offerings, and I do think that Ford, there's a real opportunity. They're losing $4.5 billion in their Model E. That's their EV segment, Model E segment. $4.5 billion is what they're losing this year. In my forecast out to 2025, I still have them losing a little bit more than $2 billion by 2025. But again, relative to this baseline, there's a real opportunity to improve that loss rate by $2 to $2.5 billion. It'll really come down to flexing the fixed cost structure of your EV production, flexing that cost structure to really match your intended volume ramp. That'll be the key.
And James, just quickly here, what is priced into Ford shares right now? Because I look at the reaction today and I see Ford shares down 0.7%. I look since the start of July, down, of course, about 24%. What's actually priced in here?
Yeah, I mean, I would say a lot of bad news today and in the future, right? I mean, there's a lot of skepticism for the incumbent OEM space, in particular, GM and Ford. It's really going to, once we get past the UAW major topic, the next debate will be one that was, front and center before the strike, which was pricing. Right? To what extent will car pricing have to come down? I think we all know that there's only one direction for pricing to go, and it is down. But there's a massive debate as to the extent of that. And so it's really going to come down to, do we have a soft landing over the coming years on pricing degradation? And yeah, I mean, I think that and the EV, the transition to EV, how that progresses. Those are the two major factors that negatively are priced into the stock right now, I would say.
All right, great to catch up with you here, James. James Picariello over at BNP Paribas Exane. A closer look at Ford. Those earnings coming after the bell tonight. Investors expecting about 47 cents a share in EPS on the back of $2.7 billion in revenue. Coming up here on the program, we're going to have a closer look here at the steam in an Energizer Bunny economy, as Larry Summers put it. We're going to have a sit down with Nobel laureate Paul Romer on how strong economic growth fits in with the Fed's efforts to contain inflation. This is The Close on Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Weston, joins us as he does every day at this time. And we all woke up today, David, with a closer look at third quarter GDP. And it surprised a lot of folks to the upside here. Sizzling hot.
How about that?
Yeah.
Including a lot of economists.
Absolutely.
So we're not predicting that at all. So we brought in an economist to try to correct us all, tell us where we went wrong. He's Paul Romer. He's Nobel-winning economist and professor of economics at Boston College. So, Paul, thank you so much for being with us. So what happened? I mean, so many people, including a lot of economists, never thought we'd be at 4.9% in the third quarter.
That's the message. Nobody expected this. If we look back, we had inflation that went up during COVID. The Fed raised interest rates. Inflation's come down very consistently, so that was kind of expected. What didn't happen was unemployment didn't go up. Growth didn't slow down. And everybody thought the theory was you could only bring inflation down when the economy slows. And that just is not true right now. So right now we're at a period where we got to just look at the facts and not be, confused by some theory that turns out to be wrong.
Well, was everybody wrong? In fact, can we bring inflation down and still have this much growth going on? Is that possible, do you think?
This is what the facts are showing us right now. Now, will it happen the next time we have a bout of inflation? We don't know. But it's clearly what's happening right now. We've had 12 months where every single month, except one, 11 out of 12, you compare it with the inflation rate a year before, and it was lower in the past 12 months than the ones before. And you add up the reduction, we're down by like 2.4% over the last 12 months compared to the previous 12 months. So a really big, very consistent reduction in inflation that nobody thought was possible in an environment of steady growth and high employment.
It raises the question, though, as to sort of what sort of caused the inflation in the first place, because there was a lot of discussion that if some of the uptick in inflation was indeed much more related to the pandemic and the supply chain issues, that once that sorted itself out, you can end up in this kind of, for lack of a better word, that soft landing scenario.
Yeah, I think that's right. So we might have periods of inflation that are like the one we're in. We might have other periods of inflation that are kind of like what we got into in the 70s, where expectations are not anchored and it's a much more complicated process. But the point is that we need to recognize we don't know, and we need to just feel our way along in the dark now, look at the facts, and don't assume this one's going to be like the last one.
It gets to the question, though, as to how much room the Fed has right now to sit by and wait, right? Because there's going to be a lot of pressure on them to do something, either raise again or even, as some people want to see them cut. Is there an incentive for them just to say, this is it, we're just going to stay here?
No, I would take it one step further.
What's that?
If you look at, say, the most recent 6 months versus the previous 6 months, what's been happening, and this has been true when I looked every month for the last 6 months, the most recent 6 months, inflation's been falling faster than before. So we've not only started a decline in inflation, but it's a decline that's speeding up. It's like a descent that's getting steeper. You need to look forward and say, pretty soon we're going to be where we want to be. So we got to start pulling out of this dive. I think it's time for the Fed, not just, I mean, it'd be crazy to raise rates at this point. I think they should start cutting rates and explain to people, within a year, we're going to be at our 2% target. We need to sort of get ready to level off, because we don't want to keep descending when we bust through our, our target level.
Well, what about that? The Fed had something to do with bringing the inflation down. I think it was, record fast pace for 550 basis points, right?
And let's emphasize that. They increased them 500 basis points in 5 quarters.
Yeah.
And I think they deserve credit for moving aggressively because, inflation was high and they needed to do something.
But there's a debate going on among economists right now whether, in fact, we're going to go back to the regime of lower interest rates, the way we had it for so long, or whether they're going to be more permanently elevated for a whole range of factors. And actually, our colleague down in Washington, Peggy Collins, talked with Secretary Yellen earlier today, and this is what Secretary Yellen had to say about that question.
Interest rates over decades had been coming down, real interest rates, and that there were deep structural reasons for that, in part relating to demographics. And those underlying trends, they're still there, they're still in force. So I think it's perfectly possible that we will see longer-term yields come down, but nobody really knows for sure. But I see the higher yields as certainly importantly a reflection of a stronger economy.
So I want you to check another economist's paper here. Is she right about that? Because demographics are not continuing to grow. Certainly the United States, Europe, Japan, even China.
Listen, if Janet were a student, I'd give her an A, because she said exactly the right thing, which is we don't know. It might be that we're going to return to those lower rates from before. But she didn't say, I'm certain of that. So I think everybody right now needs to be in this, let's feel our way along, let's look and see what the numbers show. And the other thing I would emphasize is it depends a lot on what the administration can do. It might be that in a better world, they keep passing new infrastructure bills. We make progress on clean energy. We make progress on transportation, all the things we need to do. So lots more fiscal policy. That might mean we need to have slightly tighter monetary policy. So it's a little bit like back to the future of the Reagan era of loose fiscal policy and tight monetary policy. If that means like slightly higher real rates, I think that might be okay.
Well, but she also was asked about that as well, and she did express some concern about the current state of fiscal deficits and how that feeds through here into, I guess, the ratios that she feels she's comfortable with. I think she cited 2% on a real adjusted basis to GDP.
Yep. Well, so if you go back to when macroeconomics was sensible, it kind of went crazy for like most of my career, but you go back to when it was sensible, we had a notion of the balanced budget multiplier. There's a way to spend more and to raise some additional taxes, but you still get stimulus on net from X dollars of additional spending and X dollars of additional tax revenue. We've let the tax system, deteriorate, and we've let people not comply, and we're not collecting as much tax as we need to. But it's perfectly possible to keep, making these important infrastructure investments, and to collect enough taxes to close these budgets, and still provide stimulus.
Well, I mean, it's funny you say macroeconomics has gone crazy. We should point out, I mean, Congress has gone crazy too. I'm not sure that we're going to get anything sensible for a while. But I mean, that raises a challenge for a policymaker like Yellen, or whether you're talking about a monetary policy maker like Powell here. What becomes the next step? I don't mean in terms of just raising rates, but really the overall structure of how they sort of shape policy for what is going to be a new era that Yellen herself said is going to be higher for longer, but still with a lot of elements of that low rate era.
Yeah. I think Powell is on the right track when he says we're going to follow the data. I think he could be much more explicit with people about exactly what he's looking at, because he hasn't, and people around him haven't said something like, look, 11 out of the last 12 months, we had an inflation rate that was lower than a year before. So we're really coming down. And it's been coming down faster in the last 6 months than it was before. So we need to start leveling out, because we can't keep making the dive steeper. I think he needs to talk about these facts instead of just project like toughness or something.
Paul, thank you so much for being here. It's really great. That's Dr. Paul Romer of Boston College. And tomorrow we're going to talk with Evercore's Roger Altman. That's on Friday at 6 p.m. Eastern Time on Wall Street Week.
All right. Our thanks there to David Weston. Back to you, Katie.
And we do have some sad news to share with you. Byron Wien has passed away. He was, of course, a longtime market strategist, and his annual list of 10 surprises made him one of the most influential voices on Wall Street during a career at Blackstone and Morgan Stanley. He was 90 years old.
Almost 3 p.m. here in New York. This is the countdown to the close, the fastest hour on television, starting right now with the view from the top of what's going on in the markets. I'm Romaine Bostick.
And I'm Katie Greifeld.
Katie, we came into today and there was a lot of discussion about some of the earnings that we've been getting. They weren't awful, but they certainly weren't as good as people wanted to see. And you saw that massive sell-off yesterday, particularly in Alphabet, which was down, 9-10% here. And now we kind of got a bit of a repeat today. Yeah. And this time it's Meta.
This time it's Meta. Yeah, terrible day for Meta, down by 3.5–4% or so, and I cannot wait to see what Amazon puts up and what the market reaction is, because the stakes got a lot higher over the last few days.
They certainly got a lot higher here, and you see a market a bit on edge here with an S&P now testing a lot of those key technical levels down below 4,200. We should point out the NASDAQ at one point on the day also broke below its 200-day moving average. Your 10-year is lower here on the day, and one of the few bright spots out there right now, Katie, believe it or not, is the regional banking sector as a group, at least, having a pretty good day, up about 4%. But let's flip up the board here. Now, I was told that apparently you decided to wake up this morning and do a broadcast at like 2 in the morning.
I actually just didn't sleep.
So you must have been awake when those GDP numbers came out here.
I did.
I'm curious, what was the reaction on set from Sir Tom Keene and whoever else was in the studio with you? Now, what is John Farrell? Does he still work here, or
he
just,
does?
Okay.
Tom keeps saying he's on a cruise, but I'm never not sure when.
In
to
his
believe
head, he's still.
Tom, I will say it was an interesting market reaction, because it was kind of a non-reaction, and then as we kept talking, eventually yields kept dropping and dropping, and now you end up with today's price action. But actually, futures rose a little bit in reaction. Really felt like the market didn't know what to do, because we also got claims which were a little bit worse than expected. Yeah. So you add it all together, and it was befuddlement. But now we obviously have a clear move.
Yeah, and I want to point out, too, with that chart, too. I mean, now you kind of all said that GDP now from the Atlanta Fed overlaid over that, which, of course, is like a real-time, day-to-day. And there are a lot of people who've kind of poo-pooed that. They were saying, oh, this isn't accurate here. It's actually been relatively accurate over this most recent cycle in terms of predicting the actual quarterly numbers.
Yeah, they're eating crow today, because what a blockbuster report. 4.2 5.9% on that GDP figure. But let's talk about some of the individual movers in the stock market right now, because actually I have a lot of bad news. Somehow I picked three losers today.
Nice going, Katie.
Start with Hertz, down 12%. This was interesting. Of course, this is an earnings story. They had missed estimates. That's largely due to what's going on with Tesla, those price cuts. That has hit the value of their fleets, and you can see it's hitting shares quite a bit today, down about 12%.
I'm so confused by this story here. So this was about their fleets, right? Not necessarily about the overall business in terms of demand of people like you and me renting cars.
Yeah, basically, I mean, now there's a lower EV resale value. They have higher repair costs at the same time. You add it together, and that's really weighing on results.
Did they not think of this ahead of time?
Were they expecting Tesla to cut and cut and cut? I'm not sure.
Isn't Tom Brady, isn't he doing commercials for them or something?
Yeah, I feel like Tom Brady's doing a lot of stuff.
He's kind of stretched, right? He's advising Ed Bastian at Delta. Wasn't he advising?
Yeah,
Hertz?
exactly.
And I'm sure he's got something else.
He really likes transportation.
Yeah, he doesn't like strawberries for some reason.
No, nightshades, they're bad. I think they have to do something with the swelling of your muscles. Let's talk about Bristol Myers Squibb, though.
I had strawberries this morning, so.
I have acid reflux, so I can't. But in any case, Bristol Myers Squibb also having a terrible day, down about 5.4%. That's after the sales targets for some of their new drugs were pushed back. Remember, you had Revlimid, that patent expiry. Now investors had been looking to some recently launched medicines. You think about psoriasis, melanoma to fill that gap, but several of them are underperforming. And now there's worry that basically Bristol Myers Squibb won't be able to reach that forecast for $10 billion in sales for some of these new drugs.
Interesting. Here, I mean, I guess I sort of get it here. Yet another one up on the board I thought was interesting, and that was the new kid on the block, Kenvue.
Kenvue.
Here, and I don't know, is this the first report since they came to market?
I feel like you know the answer, and I'm not quite sure. But
okay. Well, why is it down? Just explain that to me.
Well, bad news for Kenvue, good news for us. Apparently, there's a slow start to flu season, and that is hitting their shares a bit. Again, slow start to cold and flu season. This is a company that makes Tylenol, etc. That's not good news. You can see the shares down about 4.9%. I didn't know this. They actually also make Listerine, the mouthwash. So that didn't help, though, in this latest report.
Yeah, is that a high margin business?
Apparently not, no.
I don't know. So anyway, so the end result of that is we need to get sick a lot quicker and a lot faster for them to actually make money here. All right, nice run through there here. A representative, I think, of some of what we're seeing in the market here. A mixed day with the S&P down 0.4%, the NASDAQ down more than 1%. But the bright spot, believe it or not, is the Russell 2000, largely on the backs of a lot of those regional banks getting the bid here on the day. Let's get some insights out of Bryce Doy. He's Senior Portfolio Manager over at Citi Investment Associates, joining us right now to help us count down to these closing bells here. And I want to start off not with equities, Bryce, but actually what we've been seeing in the Treasury market, in the fixed income space writ large, because that appears to be where most of the volatility is at. But it also, at least for a lot of folks that we've had on this program, Bryce, some people seem to think that that's where a lot of the opportunity is right now. Do you share that view?
I do. I think the volatility in bonds is natural when you come to an end of an interest rate cycle. It can be disconcerting, but it also creates opportunity. And where we're seeing right now with core bond yields in most of our clients' portfolios at 6.5%, I mean, it's an incredible real yield. You saw this morning's GDP number being strong, but what gets less reported is that the inflation component, core PCE, the Fed's favorite measurement of inflation, was only 2.5. So if you're earning 6.5 in bonds and inflation's only 2.5, the real yield is 4, which I actually can't even remember when it was that good. So we think it's going to be a very strong market for bonds when things kind of settle down here, and it's a good entry point here with rates being up where they are.
And it gets to also the issue, too, that when you're sort of comparing the attractiveness of the fixed income space, particularly sovereign debt, on a risk-adjusted basis with what the returns that you can get in the equity market here. I mean, we know that premium in the equity market has really just kind of disappeared. Maybe it comes back. But does this mean that this becomes a shorter-term, tactical-type trade, or is this something you're advocating for a longer-term, structural type of investment?
Well, everyone's been so overweighted equities for so long. I don't think they even remember what a neutral weighting is. But what we've been telling people is that just be less overweighted. So make a strategic shift, not just a tactical one, because the risk-reward trade-off looks fantastic. Stocks are going to continue to bounce around with 18% vol. Bonds, granted, they have less vol, but let's look at the upside to downside ratio. the odds of yields going up another 4% is pretty slim. The odds of them going down 0.5 to 1% are pretty decent. So your upside downside ratio on bonds is way better than stocks, on top of the fact that they're just more stable. And what kind of return are we going to get long term on stocks? I don't think it justifies having such an extreme overweight that most pension plans, endowments, and even individuals have had for so long. I can understand when rates were zero, that made a lot of sense, but not now.
And to that conversation about the risk reward in fixed income right now, you're probably not going to see yields go up another 4 percentage points unless something truly amazing happens. Bring that conversation along the curve. What does the risk reward at the long end of the Treasury curve look like right now?
Right, there's still some downside there because as the curve steepens, that means the 30-year probably isn't going to go down anytime soon. Could actually still go up. And with the price volatility on a 30-year bond being, so extreme, it's a little tough. But if you look at buying a 3-year corporate bond at 6.5%, you wait a year, you book the 6.5% income, you have a 2-year bond, rates would have to go up over 3% to wipe out your income. So as rates go up, those shorter bonds, even 5- and 6-year bonds, look more and more attractive on a risk-adjusted basis.
But Bryce, why bother with any of this? Why not just sit in cash? Because you're getting equivalent yields, arguably, at the short end without any duration risk, without any credit risk.
That's a good point. I kind of like a barbelled approach where you do keep some cash at 5.5%, and then you put some money further out the curve because there's a lot of headwinds out there with mortgage rates at 8%. Companies struggling to finance inventory with how high their rates are, banks pulling back on lending. There's a slowdown coming. The bond market really needed to just get this big third quarter GDP number out of the way and look forward to slower economic growth. And what that's going to do is bring down lower term rates. If you're all in cash and T-bills, you're going to miss it. You're not going to be able to lock in 6-7% yields further out the curve. Mm-hmm. We would love to see, to be able to lock in a 6.5-7% yield for, let's say, 5 to 10 years. I think that's going to be a pretty good run for bondholders.
Bryce, I was walking down the street here in New York the other day, and there was this guy. He had one of these vending tables, where they sell, stuff. He was selling Christmas ornaments. And I was like, it's not even Halloween yet. So first, I just want to thank you for actually not forgetting what is still, in my opinion, one of the most fabulous holidays of the year. I should also point out, of course, that Halloween comes at the same time that the Fed is supposed to meet for a meeting that most people expect they're not going to do anything. But still, a lot of people are on edge. And I'm wondering what you actually want to hear out of Jay Powell that would give you a little bit more comfort about stability in their decisions with this rate hiking cycle.
Yeah, well, the Fed's policies have been scary, so I'd like an end to that on Halloween. And the economists that you had earlier, I understand that the Fed and whatnot, they're used to using models when there's too much demand. Well, we had too many shortages, which you also pointed out earlier, and that's what was driving inflation. So we've seen a surge in the workforce, okay? And as more employees have, people have come into the workforce, inflation has gone down. We've caught up on shortages. The increased supply of labor cheapens the cost of labor. And so we're seeing a very, very strong quarter of growth with inflation coming down very, very, very substantially. And that all makes sense to someone who runs a business or just common sense people that are PhDs in economics. And so we just need the Fed to kind of catch on to that and stop thinking that the only solution is to just raise rates forever. And if we could just get any kind of indication that they accept the reality of increased employment coming along at the same time as inflation going down, if that light bulb could just go off, that would be a miracle, but it would be wonderful news.
Bryce, it's great to chat with you. Happy Halloween. That is Bryce Doty. He is Senior Portfolio Manager over at Citi Investment Associates. Now, coming up, we'll have the latest on Sam Bankman-Fried as he prepares to testify in his own defense at the FTX trial.
Plus, a sit down with John Chambers, the former CEO over at Cisco, now running his own VC firm. His focus on AI and the state of the technology sector.
And as we head to the close, we'll get insight on the markets from Jason Pride, CIO for Private Wealth at Glenmede. All that and more coming up. This is The Close on Bloomberg.
The sell-off in markets prompted by the disappointment in earnings continues for yet another day here. You're taking a look at an S&P 500 down about 0.7% here on the day, well below that 200-day moving average, below that 4,200 mark. But the big story of the day might be what we're seeing with the Nasdaq. The Nasdaq Composite joining the S&P below that 200-day moving average, a trend line now firmly to the downside for the two of the big indices here in the U.S. Now, whether you get a little bit of help out of financials, which have been higher for a good portion of the day, remains to be seen. But remember, we've still got some critical earnings on tap over the next few days and weeks, including Amazon tonight and, of course, Apple next week here. Whether that's going to be enough to save the market remains to be seen. But remember, with four of the Magnificent Seven, or at least three of those four of those Magnificent Seven stocks that have reported disappointing big time here, Amazon, Nvidia, and Apple are going to have a lot of heavy lifting to do to help boost this market back to those valuations from earlier this year. Abigail Doolittle is standing by right now for our Options Insight segment. And Abigail, you've been taking a look here at rates, volatility, and risk management, I'm told.
Well, I'm not looking at risk management, but our guests will be looking at risk management. It's interesting because right now with bonds, yields close to 5%, so many people are saying it's the trade, the patient trade, get paid to wait, and that there's not a lot of risk there. Well, Arnim Holzer, global macro strategist at Easterly EAB Risk Solutions, whew, I made it. You see it otherwise, that it's not quite as easy, and it's certainly not something that folks at home want to try.
Right. It's a great question, and it's very much a la mode. The idea that high yields, that coupons are going to save your asset allocation, and they're a lower risk trade. And I think on paper it looks that way, but the difficulty is the correlation of bonds and stocks has actually hurt investors quite a bit over the last several years. And we still have things like the basis trade. We still have issues like the BOJ that could decide what they want to do about QE and about rates. And some of those things would be shocks that most people don't understand, and they could ripple across fixed income.
So we weren't planning on talking about the BOJ, but I'm so glad that you brought that up because one of my colleagues here, Doug Krisner, we often talk about the BOJ, and it's interesting because they really, they had a lot of bark, but then they didn't have as much bite. But if they do decide to tighten, what does that do to treasuries here? And then how does that ripple through, other assets and volatility here in the U.S.?
Well, it's really about unexpected moves, and to the extent that you could have money leave the states, and there is a repatriation, there is some concern around dollar assets, treasury holdings. There have been a tremendous amount of repositioning short in treasuries, not just from the basis trade, but also because you've seen lower purchases from Japan and from China. But all those things do is they serve to destabilize what is kind of the trusted environment, the correlation of certain kinds of relationships. That's where we put a lot of effort into looking at, is this yield trade really make sense if some of those unintended consequences occur? And what we basically do when we advise clients is we say, look at where we are in the correlation patterns, look at where we are in history, and just see if the payoff, if there's real asymmetry. If there's not asymmetry, that you shouldn't be taking those risks.
So one thing that higher yields that are around at least right now, and there seems to be reason to think that they might stick around, and that would especially be true if the BOJ were to tighten and the yen carry trade would fall away a little bit. Well, we have stocks lower. We now have the NASDAQ 100 in an official correction, the Russell 2000 not too far away from a bear market. From a hedging perspective, it's interesting. There's not a lot of put activity, and I believe that that's a reason that the VIX is somewhat suppressed. But what do you like? More, I think, gold, correct?
Well, first of all, we try to find assets and cross assets where you can actually still see value. And, the VIX has moved off that 13, 14 bottom to the 21 level. The S&P, as you said, is down to 200. I think there's still some room with Qs. But gold has this central bank building of reserves. We're seeing some fundamental secular changes with regards to the attractiveness of the dollar as a reserve currency. And gold seems to be where central banks are trying to build their war chest. So we do like, in fact, December trades, a 188, 198 December a call option trade, call spread at about $1.30. It looks very interesting to us. We think that the correlation of gold has historically been kind of low to equities. And if we do get a credit event in the fourth quarter or the first quarter because of a rollover, we think gold benefits. And we also think there's still this belief that, the inflation boogeyman may not be as beaten as you think. There was a pretty negative Ford settlement here. We don't know what's going to happen with Stellantis and GM. We think expectations across some other industries may be impacted. So I'd be careful about just assuming. I've heard some of the commentators before saying, oh, inflation is really well under control. I'd be careful about that.
Yeah, I think the Fed agrees with you from the standpoint that they don't want to see the 70s reoccur.
Right.
Great perspective. You've really brought a lot into this conversation. Arnim Holzer of Easterly EB Risk Solutions, thanks for joining us for Options Insight today. And from New York, this is Bloomberg.
Well, Sam Bankman-Fried testifying today in the high-profile fraud trial over the collapse of FTX. For more, let's bring in Angela Moon. She is Bloomberg News managing editor. And Angela, you were just walking us through what actually happened today. So as I understand it, SBF, he's testifying to the judge, but the jury isn't actually listening to him.
Right. This is a strange sort of situation and definitely a surprise for the jury who were sent home this afternoon. Basically, what the judge is doing is he's trying to hear the case that Sam Bankman-Fried is making and seeing whether this is relevant at all to the case and whether he should be presenting this to the jurors. Now, one of the main things that the Sam Bankman-Fried side have been arguing is that, yes, he made all these mistakes and wrong business decisions, but he did not make them alone. There were lawyers, there were legal counsel, there were industry experts who were advising him on doing all this stuff. But the judge thought it was irrelevant to the case, and it might confuse the jurors on how much weight these kind of advice and suggestions by lawyers should weigh in these kind of conversations.
So the next step here, the judge will listen to him, decide whether or not the jury needs to hear this, and if he decides yes, then potentially the jury tomorrow hears it?
Yes, then the jury comes back, resumes tomorrow, and Sam Bankman-Fried will be able to deliver the case that he delivered to the judge today to the jurors tomorrow morning.
What about this sort of legal point that we've been reporting about, that they want to sort of attack, I guess, some of the lawyers that were representing some of the people that testified against Sam Bankman-Fried, saying that they were involved in some of the transactions that eventually led to the collapse? Is that
right? So Sam Bankman-Fried, he took stand about an hour ago, and for the entire hour, he's been trying to convince the judge that the lawyers were involved in every step of the way in the decision-making of that ultimately led to the collapse of FTX. And this includes from the reason why they started using encrypted messaging apps as a main method of communication to the terms of services that were drafted by the lawyers. And he actually said at one point that he thought under many circumstances that it was okay for him to remove funds from FTX to Alameda based just on the terms of services that the company had.
But is that an argument saying that he got legal advice, or he felt that he was getting a legal advice in some way that justified what he did?
I mean, it's a blurry line, right?
Yeah.
It's whether he actually got the advice or whether the lawyers never stopped him or said anything.
Gotcha.
The silence, right? He kept saying, like, all of these lawyers were involved in these conversations, and they never went to him and said, they never said you can't do this or you can't do this.
But if I go into a store and I steal a candy bar and they see me stealing and they don't stop me, it doesn't mean I didn't steal it.
Exactly.
Can we just meditate on the fact that Sam Bankman-Fried is testifying at all? Because his defense lawyers didn't necessarily suggest that he take the stand.
Right. So this is definitely a risky move and an unusual one. Defendants usually in criminal cases do not do this because it opens up the risk of a very hostile cross-examination, which we think Sam Bankman-Fried will get from the prosecution. But if you think about it, after sort of like the bombshell testimonies from Caroline Ellison, Gary Wang, all of those, very close friends of SBF. After that, it was really his only opportunity to tell his side of the story.
And just to be clear, so if he does testify again tomorrow in front of the jury, is that it? Is that basically the end of the actual trial, and then from there it's just the closing arguments, or is there more?
Sure. So tomorrow would be likely the defense's testimony, and then from next week we will see the cross from the prosecution, which will be very interesting, and then the jury deliberation, and then we could see the verdict as early as late next week. So
all right, we got a lot to look forward to: a Fed decision, a potential SBF trial decision.
Did you watch this documentary? Did you go to this?
Didn't.
I think it's called Are You In, or is it Ruin?
Ruin.
Did we ever figure this out?
We're still debating that. We're still debating that. But Bloomberg's Angela Moon, thank you so much. And of course, you can watch Ruin, or Are You In, that documentary, of course, on the collapse of FTX on Bloomberg Originals. Much more markets coverage coming up here on The Close. This is Bloomberg.
This is the countdown to the close. About 30 minutes left to go here in the trading day, Katie.
And it's another ugly day on Wall Street. The S&P 500 off by about 0.8%. You take a look at the sector level, though, it's more of a mixed picture. You do have some green on the screen. Real estate up by 2.3%. Materials, too, having a good day. But the circle is broadly red, and you look at what's dragging it there. Consumer discretionary, information technology, and then communication services down at the bottom. Romaine off by about 1.9%. I would call all of that kind of tech names.
Yeah, definitely tech is what's been driving this market for today, for the week, the year, and quite frankly, probably for the last 2 decades. Meta Platforms, unfortunately, dragging it in the wrong direction, down 2% here on the day. But that's enough to really cause some broader market weakness overall. Once again, another big giant out there in the weightings in these S&P 500 and the NASDAQ, disappointing investors to the downside. Whether that actually flips to the upside after we get results later tonight out of Amazon remains to be seen. Those earnings on tap will have full coverage of that in just about 30 minutes or so once they cross the wire. We're also going to get some earnings out of a lot of other companies outside the tech space, so we can start to get to that part of earnings season where we get more of a cross-section of the economy. We get U.S. Steel, the original X, up 1% here on the day as we wait their results after the bell. And Capital One, we've already heard from American Express and a couple of other card services companies. Be interesting to see how Capital One is faring as well. Investors, they're betting that we're going to hear something good. Those shares, Katie, up 1% on the day.
Well, as we await some of those big earnings, let's get some insight on the landscape for investing in the tech sector. And I'm thrilled to say that joining us now is John Chambers. He was, of course, the longtime CEO of Cisco, helping it grow into a powerhouse company during his 20 years of leadership. He's now the founder and the CEO of JC2 Ventures. Joining us on set, it is great to see you. And
Katie, it's a pleasure.
It is a pleasure.
Now, you're going to give me an easy question at the first one so we can tee it up, and this is your best interview of the day, right?
Well, I was waffling on where to start with you, and I feel like we have to start with artificial intelligence. When you look at your portfolio right now, how heavily represented is AI in your portfolio companies?
Well, I have 20 companies that I've invested in. I get my pick of the litter anywhere in the world. It's not necessarily fair, but when I did 180 acquisitions at Cisco, most of the startups want me to be their advisor and their business partner. So originally 6 were AI companies, now all 20. Every company in the world become AI. Now, to the indirect part of your question, in 1993, when I said the internet, that was when people were getting Cisco confused with the food truck. It's going to change your lives the way you work, live, learn, and play. It was outcome-based, and almost nobody bought into it. I bought into AI 7 years ago. That's where I made my big investments. Some of them, like a Unifor, have gone up 100x approximately already and still has a great runway in front of them. And if you look the effect at AI will have the same effect as the cloud and the internet, except more. So it's going to be the most fundamental change that has ever occurred in technology. It will be the platform for every technology company, but every company, every government, every person around the world. And so that's where Satya Nadella got it right. This is a platform play, as he said in his most recent shareholder letter, that they're going to organize their entire stack around it. Bill McDermott, when he announced his results from ServiceNow, said, we are not talking about AI anymore. We are implementing it.
Right.
So for investors, if your company you're investing in does not have an AI strategy, you're already in trouble. And the question you ought to be asking them is, what are you implementing within AI? Usually starts around customer service being the hottest application to start with.
Well, when it comes to the investing standpoint, when you're looking at a company, are you more concerned in trying to find the companies that are building sort of the picks and shovels of AI, sort of like the NVIDIAs of the sector? Are you trying to find companies that are implementing AI and making their processes better? Where's the bigger
I'm looking at both. I just had the good fortune a little bit over a year ago to sell Pensando to AMD. And clearly, Pensando was the lead at the edge of the network and networking, storage, et cetera. It's going to be a great acquisition for Lisa. And I'm presenting the CEO of the Year award to Lisa tonight. And her numbers are identical to Steve Jobs on what she's done in 9 years and what Steve did in 14 and a half years.
Yeah.
I also look at where the software and differentiation is. So my investment cycle is very simple. Business model, changed by new technology. A CEO I really believe in. My customers tell me who to invest in, like they told me who to buy at Cisco, and they've got to match my culture and values.
How do you, though, I guess, separate the wheat from the chaff? I mean, you're drawing parallels between what we're seeing now with AI and kind of what we saw in the internet revolution that Cisco, of course, was at the helm of. But as you know, you had a lot of competitors around you at that time that don't exist today.
Well, there are a lot of parallels. The example with the internet, we had 4 major competitors. None of them exist today. And then we had big players come at us, and they did not succeed. And in the mainframes, whoever led in mainframes did not lead in many computers. Many computers, whoever led there didn't lead in PCs and client server. Whoever led there did not lead in the internet. And whoever led in the internet did not lead in the cloud. This might be the first time there'd be an exception. So when I look at AI players, I have a number of competitors, and I hope that mine are going to be 2 or 3 out of the top 5. But I look at the big players like Microsoft, like what you're seeing at Meta, what you're seeing at Amazon, actually view they will be, for the first time, really challenge this paradigm. They're betting their companies on it, so they aren't hesitating. The difference, I'm sorry.
Go ahead.
The difference is the speed of this is going to be dramatic. And that's going to have implications for your investors about which companies to invest in and which ones not. And the disruption will be faster. My worry is that we will destroy jobs faster than we create new ones, where with the internet, you had a longer period of time to do it. Will AI over time produce a lot more new jobs? Absolutely. But the speed is breathtaking.
There's a big question, too, about the client side and the customer side of this. Is this something that is primarily going to be, I guess, for us here in the U.S. and maybe some of the other big developed economies? Or are we going to see this technology, I guess, proliferate around the globe? Meaning, what is the market going to be for this beyond just the U.S. borders?
Every company, every country, every individual over time will use AI just like we use the internet, except it will occur faster.
Will it be accessible and affordable for them to do that?
It has to be. In ChatGPT, it isn't really free, but and it's an example. And I think it's great because all of a sudden people can play on a level playing field. I can have a startup, if you watch in cybersecurity, which I think is going to be the other real hot area over the next several years if your investors are interested in the areas that I'm really betting on. And you can take a company like Safe, which is an up-and-coming young startup that quantifies cyber risk on a scale of 1 to 100, and then CEOs can make decisions off it, tie back to insurance. But they use ChatGPT, which they call creatively Safe GPT. They created in 31 days the capability to have the #1 leadership position in all of cyber risk assessment using AI in 31 days. That says disruption will occur everywhere very fast.
Do you see consolidation in the cybersecurity space at all?
I think that's what's been missing because you nailed it. One of the problems, your investment in cybersecurity, for your listeners, cybersecurity is not growing much this year. That was a shock because it's a huge mistake. Will the MGM Grand $100 million problem occur again? You betcha. Will the Clorox supply chain $500 million charge occur again? You betcha. The reason that you're not seeing them growing is they're taking what discretionary spending they have and put it on AI, but you have to have 50 or 70 cybersecurity companies to solve your problem. And by the way, as a person that really understands intelligence around the world, if you have 50 to 70 solutions that aren't working together, the bad guys will always find the weakness. So this industry is set up for consolidation. I have players that I think maybe could play in that, like a Rubrik. It's a company that is currently private on it. You have great players like Palo Alto, Cisco, CrowdStrike that also are looking at consolidation.
You sound very excited. You must be having a lot of fun. Is this more fun than running Cisco?
Oh, it is. Now, running Cisco at first is a rush. I mean, you go from 400 people to 75,000. You create 10,000 millionaires among your employees. You change every business in the world. You help to bring peace, hopefully the Middle East, which we need help on again, obviously, in many ways. And you win every corporate social responsibility award there was. That was a rush. But this is more fun because these are like grandkids. And you get to work with them. You've seen every movie. They think you're really smart. Well, I've messed it up twice already. I ought to be smart this time through. And they view that they trust me as their mentor, their coach. And, you know, some of them have asked me to marry them in terms of being the official when they get married.
Officiator, right?
The officiator, yeah.
Okay,
exactly.
Just
Good catch.
being clear.
John, we don't have much time left, but obviously you have a very unique perch, a very unique view into the startup landscape right now. What is the environment like? Because we talk about all the time the tightening of financial conditions. Do you see that among the private markets?
You absolutely do. Now, the question, Katie, that you might want to follow up with if we have time is the private market now an indicator of what the public market can do, or is it normal lagging factor? The investments in terms of the startup communities are really tight now. You have approximately 50% of the startups operating with less than 12 months of cash, which is a bad number on it. The investments by the VCs are slowing dramatically. If you look at the secondary markets, which I'm just beginning to understand, in private companies that are not public yet, they are between 40 and 60% off of their original last fundraising level. So that's going to be tough. There's going to be a consolidation there. Cash is going to be king. If you're not positioning yourself for cash, you've got a real problem in the market. The question is, are they an indicator of what's about to happen in the public market or not? I'm normally an optimist. I'm concerned about the next 3 quarters because of cost of capital, the implications in terms of do you have enough cash to get through it. The effect it'll have on commercial markets, you guys understand. But the effect it's going to have on startups and even larger companies is going to be dramatic, and I think we're underestimating it.
John, we have to have you back soon. Really enjoyed this conversation. Our thanks to John Chambers. He is the founder and the CEO of JC2 Ventures. Now, coming up on The Close, Morgan Stanley has chosen its next CEO, and Bloomberg sat down with both executives on its succession plans. More next. This is The Close on Bloomberg.
It's sort of what you hope for. I mean, you try and drive strategy, you try and put together a team, you try and deal with the inevitable knocks that you get from the market and the disappointments that come in times in any complex business. But at the end of the day, you're also trying to hand it off to the next generation. So it feels great and it feels right.
That next cycle is going to be investment banking led, and it means that in equities, we want to be 1 or 2 every quarter as we have been for the last decade. We have a fixed income business we restructured. It's now a top 5 business, and investment banking is going to lead the next cycle. There's going to be a lot of M&A consolidation. It's going to be across industry groups. The world's gotten smaller. There's a new cost of capital. We want to be a leader, a global leader in all those spaces.
That was Morgan Stanley Chairman and CEO James Gorman speaking first, and speaking second was his newly selected successor, Ted Pick, the co-president of Morgan Stanley, going to be moving up in due time to the CEO role. Sonali Basak had a chance to sit down with them a little bit earlier, Katie Greifeld. And I think it's interesting because there was a lot of talk when Gorman first made the announcement, or the company made the announcement, that Gorman would step aside back in May, or May of this year. But they were just kind of like, oh, this will happen over 12 months. We don't actually have a successor, and that could have just set off. Everyone went apoplectic. And then everyone said, just name Ted Pick.
Yeah.
I mean, it's right there in his name, Pick him.
No, he's been heir apparent for a while, right? I mean, he's been prepared for this role for about a decade. So it was interesting to see that lag time. More interesting, potentially, that you have both of the other 2 names staying at the company. Of course, Andy Saperstein, Dan Simkowitz. It's been a long day. Pretty good succession plan.
Yeah, let's hope so. It sticks. This is The Close on Bloomberg. This is the countdown to The Close. I'm Romaine Bostick. Joining me right now is Scarlet. She joins us every day at this time to help take us to the bell and beyond. And another kind of repeat of what we saw yesterday, Scarlet, which was you had a couple big tech names report, a couple big tech names disappoint, and that sent the markets lower. We had a rinse and repeat of that with Meta last night, and now an S&P down more than 1%, and the NASDAQ headed for a 2% loss.
And the NASDAQ 100 in correction mode, down 10% from its peak, and the S&P 500 teetering along that line as well. Earnings has not been the salvation that investors were hoping for, has it?
It hasn't, and I mean, I'm not sure it was going to be. I mean, most people came into this quarter saying that things were going to be bad for 3Q, relatively bad, but that was going to be sort of the trough, right? And the idea is that 4Q would pick up and beyond. But it's not just the numbers that we've gotten for the past quarter, but even some of the forecasts that we've gotten out of these companies haven't been necessarily all that aggressive.
And that's what did Meta in, right? Because Meta's numbers for the quarter gone were pretty good, especially on the advertising front. But really, it was the outlook and the lack of visibility into what they could see for this quarter, for the next year, that really got investors concerned. At the same time, you have Treasuries catching a bid. The 7-year auction saw pretty decent demand.
It saw decent demand. Is that people trying to lock in the rates? Is that safety trade? According to Janet Yellen, these rising yields that you've seen is apparently just a sign of a strong economy.
It has nothing to do with the extra supply, right?
Yeah, I don't know. I have to break this to you, Scarlet, but we have the Magnificent Seven. I can see you're perplexed by this as well. Just throwing your stuff on the floor here. All 7 of those names down on the day, and not only just down, but we're talking about 3% declines for some of the biggest and heaviest weighted names in the market. Let's get some insights out of Jason Pride, Glenmede Private Wealth CIO, joining us right now to help us count down to the closing bell. And before we get to earnings, Jason, I do want to start off with the strength of the economy, because we did get the latest GDP numbers for the most recent quarter, and they were phenomenal. And I know there are a lot of people that are saying that probably is just an anomaly. Once we get the revisions in the next quarter, things will be down. But 4.9% is nothing to quibble at. Even if you get major revisions, you're still talking about relatively healthy growth. Growth, let's face it, Jason, that at the start of this year, nobody thought was going to be present for the third and fourth quarters.
Exactly, Romaine. And let me just say, first and foremost, thanks for having me on. Look, on the surface, I think that report looked really good on the surface. But when you dig down underneath of it, you actually realize that it actually is still kind of questionable. About half of the growth that we saw there in that 4.9% came from government spending and inventory rebuild of a fairly enormous size. And then when you dig a little bit further down underneath, consumer spending up 4% looked great. But then underneath that, on a real basis, income for consumers was actually down 1%, right? So you have this kind of picture of government spending, inventory rebuilding, consumer spending, all of which kind of fall into this question mark of, is this really sustainable?
Yeah, and certainly so. And I think we're going to maybe find out a little bit more tomorrow when we get the PCE data that will show us some of the consumer spending trends for the month of September. I can't remember exactly what the forecast was, but it isn't a material change from what we had the previous months.
Right. One of the other things I think we have to take into account is, right, this is all occurring in an environment where everybody's wondering what these lagged effects of rate hikes are going to be, right? We've had the Fed raising rates for a fairly prolonged period of time, from nearly nothing on short-term rates up to 5% at this point in time. And now we have longer-term rates coming up to match it, which is putting pressure on mortgage rates, putting pressure on corporate loan rates. There's kind of this question mark sitting in the backdrop as to how long it's going to take for that to filter into the economy and what the magnitude of the impact is going to be.
Jason, how are you thinking about the 5% level for the 10-year yield? Is that the inflection point at which people come in and start buying? Because we had the 10-year get to within 1.2 basis points of that 5% level before yields started turning south.
Right. Look, I don't know if it's the exact inflection point. What I can tell you is that at 5%, we got interested. I can tell you up until now, what we've done with the portion of our money that we were trying to be defensive with, we are positioned in shorter term or shorter duration bonds. When you do that, what you're doing is you're effectively protecting your portfolio against the fluctuations and uncertainties surrounding interest rates. And up until now, you could basically say, look, I'm collecting excess yields there, higher than what you get out further in the curve. And I don't have those interest rate fluctuations because I just don't have as long of a duration position in place. Today, I think that argument is completely unwound at this point in time. You can actually look at and getting almost fairly similar rates across the spectrum and be willing to take that interest rate risk a little bit, particularly if you're a broad market investor where you have equities on the other side. because in majority of circumstances, if we get into a difficult period where equities actually decline, duration or longer duration tends to provide a bigger offset to that than shorter duration securities. So you're getting yield, you're getting a little bit of protection by taking that interest rate risk now, which seems justified.
We're also seeing equities decline right now for a second straight day. I want to get your take on what we've seen from earnings season so far. What is your read through on all these earnings numbers, particularly from the big tech names that were meant to be the bright spot of corporate earnings season?
Look, we've been talking about this being a fairly difficult environment for growth on the whole, not just growth stocks, like growth for the overall economy and the corporate marketplace. We've had 3 quarters in a row of negative earnings growth. This is essentially the 4th quarter where it's actually quite questionable. Look, on the surface, it looks really good. 2% ahead of expectations so far during the quarter. We've seen numbers come up. But then when you dig down under it again, kind of like the GDP report, it doesn't feel quite as good. Earnings expectations had gone from 8% when they were first started put out by analysts on aggregate, down to basically near break even right before the earnings season reporting season started. And therefore, the bar got lowered quite a lot to basically no growth whatsoever. So to see a 2% beat doesn't really feel all that good when your kind of starting point was a fairly low bar of 0 growth. And let's add to that 4th quarter growth expectations so far have already inched down about 1.5 points, 1.5% just in the last couple of days as companies have been reporting. So we're seeing those numbers now start to come down. So look, I kind of look at this as, look, we're not in a recession as of yet. The pressures are still there. But this feels a little bit more like we're limping along rather than really ramping up the economy and the corporate profit cycle.
I guess it gets that leads us to the next question. Even if we are limping along, Jason, is there a baseline there? The idea here that, yeah, things might be a little bit lame, things might be a little bit soft, but we're not talking about heading into a recession or even any sort of prolonged economic doldrum.
Look, we still have a recession as something that could easily occur still even as of now. We don't think we're at the point where the impact of the Fed's rate hikes have been fully felt. We think that actually the majority of that pressure actually comes in 1st quarter time frame. And if you actually look at economists' expectations out there, those expectations dip going into 1st quarter, 2nd quarter of next year. So we are definitely not out of the woods yet. It's not a guaranteed recession. I think our odds, our calculations favor it being a mild recession, but it's not something that's guaranteed to occur. This limping along scenario, though, if you think about it, markets are basically pricing at 70th percentile sort of valuations, 21 times earnings, which is about 16% above fair value. That doesn't seem to really make sense in an environment that feels like it's limping along like this. Normally markets price lower than this. So we've remained more defensive and been willing to kind of step over and say, we'll take a little bit more of our portfolio in that bond area where we can just collect 5% over time through this period.
All right, Jason, I'm going to have to leave it there. Great to catch up with you. Jason Pride, the CIO.
Thanks for having me.
Over at Glenmede Private Wealth, counting us down to the closing bell. We should point out, Scarlet, once we get to those bells, we have a slew of earnings here. Of course, all the talk is going to be about Amazon, but we're getting Ford, Intel, Weyerhaeuser, Capital One, Chipotle, VeriSign, Sam Adams, Boston Beer, whatever they're called, and a few other names as well. So a nice cross-section, I think, of the economy.
And of course, everyone will be fixated on what the outlook says and what we're going to hear from management about what kind of visibility they have moving forward. I'm looking at the S&P 500 near its session lows, off by more than 1%. What's interesting, Romaine, is when you look at the advanced decline line on the NYSE, 5 advancers for every 4 decliners.
Yeah, unfortunately, they're not the heavyweight advancers, which is what you need.
7 companies.
Yeah, I mean, the Big 7, the Magnificent 7, whatever we're calling them. But even when you expand it out here, I mean, I think I was looking at like the top 20 weightings in the S&P 500, and you had like 15 of them, not only in the red, but significantly in the red, too.
Yeah, significantly in the red. Big drags on the market overall, and certainly casting a pall over this sense that this was the earnings season where things were going to turn around. The earnings recession was going to end. But as Jason Pride just told us, that revision downward in 3rd quarter numbers and in particular in 4th quarter numbers is putting that idea to rest.
We get the closing bells here in New York. Red across the screen here for most of the major indices, with the Dow Jones Industrial Average lower by about 260 points, or 0.8%. The S&P 500 lower by roughly 50 points, or 1.2%, while the NASDAQ Composite, which remember had actually avoided breaking below that 200-day moving average at 12,595. That is a close below that 200-day, the first time that's happened going back to March as well. The S&P actually broke below its 200-day last week. NASDAQ Composite, I should point out, down 1.8% here on the day. And the Russell 2000, Scarlet, believe it or not, that's actually the bright spot here on the day, higher by about 0.3%, though. That's largely on the back of some pretty decent gains in regional banks.
Yeah, it goes back to that idea, but that the advanced decline line is in favor of those advancers. We also have, when you look at the S&P 500 sectors, definitely a lot more decliners overwhelming the advancing groups. Let's start with the downside. Media, entertainment, of course, that is your Alphabet and Meta, and auto and components. There's Tesla, tech hardware and equipment makers down by more than 2.4%. On the upside, REITs, banks and telecoms each gaining more than 1%.
Yeah, interesting here. Let's talk about some of the individual movers. Actually, let's take a pause here for right now. We're getting earnings coming out of Amazon right now. Let's go right to it here. For the third quarter, EPS coming in at 94 cents a share. The Street was looking for 58 cents. So a big beat on the bottom line number here. As far as net sales, $143 billion and change. The Street on average was looking for roughly about 142. So a slight beat on net sales figures there. Here's your forecast going forward. For the fourth quarter, Amazon is saying net sales will come in at a range of $160 to $167 billion. The Street was looking for about $167 billion. So the high end of that estimate would just about touch the average of analyst estimates there here. And as far as operating income for the fourth quarter, Scarlet, the company is saying they expect to see $7 billion to $11 billion in operating income. That is an incredibly wide range here. And we should point out that analysts on the Street, on average, were looking for about $8.7 billion. So there's a lot of wiggle room here for either an upside surprise or a downside surprise, depending on how they execute this quarter.
And just looking at the numbers right now, you have the stock moving higher in the after-hours trade about 2.5%. But as more numbers come out, expect to see that gyrate quite a bit. Amazon Web Services, AWS, the cloud services, net sales in the quarter, $23.06 billion. That is a miss. Analysts were looking for $23.13 billion. And of course, that's a huge profit driver for Amazon overall. And AWS is the most dominant of the big three cloud giants. So people are going to extrapolate a lot from that number. Of course, they already have from what Microsoft and Alphabet had said.
I'm just kind of going through and I'm looking at some kind of where the real contributions to growth are. I mean, web services holding up 12% growth year over year here. But I think it's interesting, too, that the traditional e-commerce business, if you will, also looks pretty healthy here. You're talking about 7% gain in its online store sales here. And then with the third-party sellers, the sales that they get from that, which is largely the fees that they get, that was up 20% year over year. So it looks like all the main units here had a pretty healthy quarter.
Double-digit gains, 20% gains for the retail side versus 12% for the Amazon Web Services. Things have changed pretty quickly, haven't they?
Yeah, absolutely here. But again, I mean, this is the idea here. I mean, they created these ballots. Remember, when they moved into, when AWS became a thing, before it was really called that here, there were a lot of people scratching their heads as why Amazon was going down that road. Oh, you're going to build server farms and hold everyone safe. That's ridiculous. And of course, you know, that's where their profitability comes from.
Yeah, that's what helped them turn into a powerhouse and into that store of profitability, as you mentioned. And it allowed them to continue investing money into the business, the rest of the business, to do all these other things, including, remember, there was for a while hardware, Amazon Fire phones. I know that didn't take off, but it allowed them to experiment.
A couple other headlines crossing the wire. The company says it plans to hire 250,000 seasonal employees in the U.S. Of course, this is a behemoth of an employer, a lot of part-time folks, but still employs a lot of folks. And of course, that gets ramped up around the holiday season. And then this one here, I almost forgot that they are an investor in Rivian. They're saying that they actually posted a gain in 3Q from their investment in Rivian. Not quite seeing exactly what that gain was, but overall, you see the knee-jerk reaction here in the shares, Scarlet, up 5% here in after-hours trading. I think we're going to dive a little bit deeper into this, but I do want to walk through some of our, I believe we have Poonam Goyal is joining us right now, Bloomberg Intelligence Senior Retail Analyst, to talk a little bit more here about what we've learned out of the results. Anurag Rana, also of Bloomberg Intelligence, standing by as well to give his insights. And Poonam, I'll start with you here. Give us a sense here as to what sort of jumped out at you when you first saw these numbers.
Sure, I'll talk about the online side, and I think they posted really robust online gains here, double digits for the third party, which is obviously impressive at 20%. And then on their own online sales, the 1P business, you mentioned up 7%, and I think that's very healthy considering the environment that we're in. So I think they're on track to deliver a good holiday. Keep in mind that last year the compares are much easier because they did report a 2% decline in online sales. So easy compares, plus a good start to holiday with the results that they're reporting bodes well for them as they move into the fourth quarter.
Yeah, can I ask, I didn't read this number out, but they listed physical stores net sales. That was up about 5.6%, $5 billion. Is that primarily what, the Whole Foods and other things? What exactly is that?
It's largely Whole Foods. I mean, they do have Amazon Fresh stores and still some Amazon Go stores, but it's largely Whole Foods, and that business is gaining momentum. But it's still, as you mentioned, $5 billion. It's very small, so it's not going to move the needle in terms of their overall results. I think, we're still primarily focused on the 3P business, which continues to grow quite nicely. In fact, 20% is a step up from where they've been in the past few quarters. So it's nice to see that business is still gaining ground. And then on the online side, the 1P business up 7%. We expect it to be up in the mid to high single digits again next quarter. That's a good run rate for Amazon going forward. Considering its size, right, you're looking at about over $600 billion in total GMV on its platform.
In conversation right now with Poonam Goyal over at Bloomberg Intelligence, a closer look at earnings out of Amazon. We'll get back to that in just 1 second. Ford earnings crossing the wire. The company withdrawing its full year guidance here, pending ratification of that labor pact that we learned about last night. The UAW and for reaching a tentative agreement here. But of course, that still is going to have an impact on the earnings. As for those 3Q numbers, Scarlet, EPS did miss 39 cents a share. The street was looking for 47 cents a share. EBIT missed on an adjusted basis as well. Not quite seeing the sales figure here, but overall, it looks like they missed on some key metrics here, and the company withdrawing its guidance here until they get a ratification of that labor pact.
All right, we'll get back to Ford in just a moment as we digest these numbers, but I do want to bring back our roundtable, Poonam Goyal and Anurag Rana of Bloomberg Intelligence, to help us figure out more about the picture that we've seen in Amazon following their third quarter results. Anurag, I want to come to you on Amazon Web Services, the cloud business, because it is the most dominant of the big three cloud giants, and sales in that category rose 12%, which basically matches the record low that they reported the previous quarter. Is that good enough right now?
So right now it's in line with what most people were expecting, plus or minus 30 basis points. It's not a big deal. But the guidance on the call is the most important one. But I would say the one number that really stood out to us was the AWS margins. It went up about 700 basis points. So it's back to around that 30% number. And if you remember, a few years ago, they did hit that number. But since then, as the growth slowed down, the margins have been in the low 20s. We've always said this is the most profitable part of Amazon, and it has a long runway ahead. But frankly speaking, at this point, guidance is all that matters when they get on the call and say whether the next quarter is going to be above 12 or below 12.
So how did they achieve those fatter margins in AWS if revenue growth overall stayed steady at 12%?
I think if you'll remember, I mean, they did some cost restructurings over the last 12 to 18 months that I think has factors in there. Stock comp is a big portion, in that area. So
but
I think
are those one-offs, or are those things that they can keep doing quarter after quarter?
See, I think this business itself, anything cloud-related business is very much like, any scalable business. Once you have that, over time, you should get leverage off of it, which is why it's surprising this time. But I think it has to do more with the headcount rather than anything else.
I am curious here, Anurag, when we talk about just how much growth they can generate out of particularly AWS and so I guess the tech side of this business here, particularly when you see other folks in this space, primarily, what we saw with Alphabet. I know a much smaller player in cloud computing, but is there any concern here that we start to see a slowdown in some of the business spending?
See, we should be. We are seeing some slowdown. Both Google and Microsoft did indicate there is the companies or the corporations are still in the cost optimization mode. And it's possible we're going to hear the same thing on the conference call today. But frankly speaking, this is a way of doing or constructing applications that is far superior than the on-premise model. So the longer term potential of cloud is really big. And Amazon's right the biggest player there and should get its fair share of revenue from that.
All right, in conversation right now with Anurag Rana and Poonam Goyal, a closer look here at Amazon's earnings. Intel earnings crossing the wire right now as well. Let's get you those numbers here. For the third quarter, looks like a beat on the key revenue number, $14.2 billion. Street was looking for 13.5. And we should point out that the EPS number also coming in. It looks like a beat there. Here are your 4Q numbers. Here's the guidance going forward. Adjusted revenue of 14.6 to 15.6 billion. The bottom end of that range is higher than the average of analyst estimates. And their guidance for EPS at 44 cents, and the street was looking for 31 cents. Those shares higher by 7% here in after hours trading. I do want to go back to Amazon now, which those shares are up about 4%. Poonam Goyal and Anurag Rana still with us. And Poonam, I want to come back to you here and talk a little bit more about the retail side of this company, particularly with the Amazon Prime days, plural, that they have rolled out this year, and whether that had a real material effect here on what we saw in terms of growth.
So I think Amazon Prime Day, you know, they've had that in the past. It's not new. They had it last year as well in October. So on a year-over-year basis, we actually did see strength on Amazon Prime Day. We have third-party data suggesting that there was a mid-single-digit increase over those Prime days online, and that's encouraging heading into the holidays. So there was some pull forward of spend, but I do think that with consumers focused on value today more than ever, more than in recent years, that deal days like this, whether it's the Amazon Prime Day or whether it's going into Black Friday, Cyber Monday in a month, they're going to matter and they're going to be bigger.
They're going to be bigger, and I think we can expect to see more than just 2 Amazon Prime days. Where this is going to be a much more regular thing. Let me just jump in here right now and give you the numbers for Chipotle, because that company has just reported results as well. Third quarter comparable sales beating analyst estimates, rising 5% in the quarter versus the consensus estimate of 4.4%. Revenue overall, $2.5 billion, a little bit higher than what analysts had anticipated, which was just under $2.5 billion. Operating margin, a full percentage point ahead of what analysts were looking for, 16% in the quarter. Analysts were looking for 15.1%. And in terms of outlook, Chipotle says it still sees the full year new restaurants of 255 to 285. So giving a range when the consensus estimate was about 264. Chipotle currently up by more than 5%. And look at that price. I didn't realize that the per share price was that high, Romaine, at $1,900.
They refused to split. Yeah.
That's pretty remarkable.
I don't know. Yeah, I mean, I don't know. How does Warren Buffett feel about that?
I don't think Warren Buffett minds those things, given where Berkshire stock is trading. Poonam, let me just come to you for a final question here on Amazon. We talk about how the retail side has done better than maybe a lot of people had anticipated. What does that mean in terms of the kinds of deals that Amazon will roll out and force the rest of the retail industry to follow up with as well?
I think it's about just being competitive. So as we move through the holiday season, Amazon needs to stay competitive to draw in customer spend, because transparency across online sales is evident and prominent. So consumers are able to price shop. They are able to see, you know, where they want something, what the price is, and they will have to be competitive on price, especially over the holidays and on those deal days, whether it's Thanksgiving Thursday, Black Friday, Super Saturday, or even Cyber Monday.
Gotcha. And Anurag, over to you now on Amazon's web services, the cloud business. Can you give us a sense of how Amazon matches up versus, say, Microsoft on the AI front? Because Microsoft obviously has a head start on everyone, but Amazon has talked about making investments on its end too.
Yeah. So if you look at the the local or the inherent AI stuff, I think all the three companies are very much in line with each other. That's Google, Amazon, and Microsoft. The real edge that Microsoft has right now is its relationship with OpenAI, which is feeding to some of the growth in Azure at this point. So I have no doubt in my mind that over the next couple of years, all three companies will get their fair share of workloads or AI workloads as people start spending more money into it. The bigger issue right now is a shortage of cloud providers. It's not so much that one person is going to get most of it.
Anurag Rana over at Bloomberg Intelligence. Poonam Goyal, his colleague, also at Bloomberg Intelligence, two of the best that we have under our roof here at Bloomberg. We thank them for jumping on to help break down Amazon's earnings. We're going to continue our coverage right now of those earnings. The shares higher in after hours trading on the back of some a pretty big beat on some of the key metrics. Eric Clark is joining us right now. He's a portfolio manager over at Accuvest Global Advisors. And you know, I am sort of a glass half full, half empty kind of person, Eric. So I'm always sort of looking to find the canary in the coal mine. And just looking through this release, it's hard to really see anything really bad. I don't want to overstate it, but this seems to be the type of quarter that any investor would be appreciative of.
Yeah, when you do $1.5 billion of revenue a day, and it's pretty predictable, that's not so bad. And frankly, the bar was set so low by some of the peers that, you know, the stock's off 8% going into the print. So that's usually a pretty decent setup unless they have some real problems. And I don't see any in the data that I've seen so far.
I am curious. I mean, you guys over there at Accuvest are primarily thematic investors, and I'm curious as to what is sort of the theme with Amazon. I mean, when we talk about a Microsoft and AI or NVIDIA or some of these other tech companies, there seems to be a much more of a clear theme as to what investors are buying into. Has Andy Jassy and Amazon established what that is for them?
Well, I think he's finally gotten the message that you need to focus on your CapEx. And you need to get back to your core retail margins where they were. You know, they went down in COVID and they had a massive kind of historic spending cycle for the logistics business. And now that's rolling off. And some of that CapEx will go in for the AI effort, but that comes at a much higher ROI over time, too. So I think, you know, people ignore the retail business, but the retail business without AWS from the IPO to 2014 did really well, and the stock did really well without AWS. So I wouldn't forget about the core retail. That's still, you know, $400+ billion in yearly revenue, just at a lower margin than AWS.
And the third quarter's numbers show that the retail business is doing just fine right now as well. Putting Amazon's earnings into perspective, this is a very good set of numbers. And unless Amazon gives any kind of forecast that diminishes visibility or talks down some of the prospects, and the stock does end up staying higher, this would be only one of two of the big 7 companies, big tech companies, that have come out with earnings that delighted investors, that surprised investors to the upside. What does that mean?
Well, I mean, again, the bar was pretty low, so that's always a good thing, right? Expectations were kind of on the bearish side. Sentiment for the equity market in general is bearish, but the trends just look really good. I mean, consumers want to save money after 2 years of overpaying for everything. That feeds right into Amazon Core. And AWS, it's not a matter of if. We know public cloud is very early days. We know AI adoption and deployment is early days. So, you know, when you have two really important divisions that are all, you know, have much bigger growth tailwinds going forward, and you have a margin inflection and a lot of the operating metrics inflecting back to, quote, normal after a couple of years of subpar performance, there's some pretty powerful operating leverage in that model. And you have easing comps, too. So there's not a lot of companies that can say all of that. So I think Amazon has the much more upside return than all the other Magnificent Seven names, you know, over the next couple of years.
What could jeopardize that? Is it an expectation that CapEx will start to rise after finally bringing it down?
Well, that's certainly one, but I don't think, I mean, they built a UPS literally in like 3 years. So that kind of historic CapEx spend is not going to be repeated. Yes, there's going to be a ton of AI spend. I just don't think on a net basis it's going to be as much. And you're getting the core business start to inflect higher from a margin perspective. That pulls up net operating income. It pulls up free cash flow. So I just see really, really important things. And you know, if you doubled revenue in 2 years or in the last 3 years and your stock's negative 8% annualized for 3 years, there is a major mean reversion coming in the stock price, too.
I am curious about international expansion and sort of what options they have there. I know they had made some inroads into certain markets, but of course they ran into some trouble in India and elsewhere.
Yeah, I mean, that's still obviously a smaller part of the business. It's still losing money. Generally, it's taken about 7 years before that profit inflection happens. It will happen. Eventually, it'll start contributing too. But primarily, it's, you know, if you look at the last, you know, since the IPO, you have core retail going up like this in revenues. Then you have AWS coming up. So AWS is becoming a bigger and bigger piece. That's probably just using a Microsoft comp. That's worth $1 trillion, $1.1 trillion. use, the core retail. Let's use Costco as a comp that's 2 times a Costco. Plus you have the ad revenues. Let's take, some of the Google comps there. And so you have a stock that's sum of the parts is worth, 1.9 or 2 trillion, and it's 1.2 today, which is why we see so much upside.
All right, Eric, this was great to talk to you. Eric Clark over at Accuvest Global Advisors, a look at Amazon, a company coming in with $143 billion in sales in the most recent quarter, and that was up 13% from the previous quarter. Profitability ensues, and the guidance that they've given seems to be pleasing investors. And Scarlet, this is a nice setup for tomorrow, because remember, yesterday we were having a conversation about just how much the market was going to fall the next day because of how bad those earnings were. But you have good earnings out of Amazon, good earnings out of Juniper, good earnings out of Intel, Chipotle, Deckers, Dexcom, Capital One, and quite a few others.
But we got to wait for the conference call. They could say something in the conference call about this quarter that changes everything. You're a glass half empty kind of guy. Come on.
I am. I'm going to take this and just say la. Anyway, a company that is under pressure, though, is Ford here. We're going to get some insight on the earnings that we just got out of the automaker here and them withdrawing their full-year guidance. Now, that is pending ratification of that tentative deal that they struck with the United Auto Workers Union. But remember, that 40-plus day strike had a big effect here on output of some of those vehicles. That conversation after the break. This is Bloomberg. A lot of earnings crossing the wire over the last few minutes. Amazon doing well, but actually one of the biggest movers here in after-hours trading to the upside, at least, Scarlet, is Juniper, which actually came out with their earnings. And they had a pretty big beat, not only in the most recent quarter, but their guidance coming in well above estimates here. And then there were a lot of other names out there, too, here. We talk about Deckers, Outdoor. That's having a pretty good afternoon.
Makers.
Yeah, and Dexcom up about 10% as well. Meanwhile, you said Uggs, right?
Yes.
Yeah. I know you own like 30 pairs of Birkenstocks. You own Uggs as well?
I have maybe 15 pairs of Uggs.
What about Skechers? Because they're not doing too well.
No,
you need to start buying some Skechers.
Yeah, I'm not the right demographic.
All right. Well, it's interesting. Skechers down 3%, but actually that's not the biggest mover to the downside. The biggest mover to the downside is Enphase. That's down 16%.
Enphase, the solar energy company. Yeah. And I was looking at these numbers, and third quarter adjusted EPS $1.02 versus the consensus estimate of $1. No big deal, right? I mean, slight beat. It's the fourth quarter outlook that is really eye-popping. $300 million to $350 million is the forecast that the solar energy company gave. The consensus estimate is $577 million.
Okay, that's a pretty big gap.
That's a huge gap. And I'm sure it's tied to rising interest rates and the fact that a lot of people need to get financing in order to install solar panels.
Yeah, that's a good point. I mean, so this all brings us back to rates once again, Scarlet.
It always does. And by the way, Solar Edge and Sunrun are also following Enphase lower.
All right, let's get to another big mover in after-hours trading. That is Ford, down more than 3% here. The company missing on a couple of key metrics and withdrawing its guidance. David Welch, Bloomberg Detroit Bureau Chief, joining us right now for more. And David, let's start off with the guidance. It said it's withdrawing the guidance until ratification of the contract. I guess that means that its visibility going forward right now is a little obscured?
Yeah, look, they do have a tentative agreement, which in theory would say that the strike's over for them and that the union said the workers will go back, but they have to ratify the deal, and it is a bit open-ended. I think maybe their attorney said there's a bit of risk here, so withdraw guidance because this deal is more than likely to get ratified. It's a very rich deal for workers. But if it didn't, they'd have to go back to the bargaining table. There could be more work stoppages down the road. Unlikely, but I think that's the risk that they're trying to wall off here by withdrawing guidance.
And we're seeing Ford shares down more than 3%, presumably on that pulled outlook. But the numbers themselves for the third quarter, David, are also below the average analyst estimate. EPS, for instance, of 39 cents, missing the consensus estimate of 47 cents. Can you talk a little bit about the timing of this deal that Ford, the tentative deal that Ford has struck with the UAW, and how the earnings report was kind of the internal deadline for the company?
Well, look, I don't think they wanted to be in the position that GM was, where GM's announcing really strong earnings, and then, a couple hours later, the union strikes another one of their plants because they saw all of these profits. Now, in the case of Ford here, the numbers aren't very good.
Yeah.
They kind of missed on EBIT, they missed on earnings per share. All oh, this was not a great quarter for the company. Their sales weren't that great. GM had a great quarter for sales, so we kind of knew that they were going to have some really strong numbers.
One thing I was interested in, I mean, I'm glad you mentioned the miss, but on Model E, I guess basically the electric vehicle portion of this business here, that was a pretty big miss, and I'm wondering what actually drove that, because I thought some of these models, at least they had gotten a lot of attention in the media. Did that not translate into sales?
They've had some downtime with some of their electric vehicles. Production at those plants, they've been pretty successful, but, EV sales are slowing down, and they've also had to cut prices to match what Tesla has done.
Yeah.
If you go back and look at Tesla's quarter, their quarter wasn't great in terms of margins. Their gross margins are now pretty much the same as General Motors because they've given away all the pricing that they used to have to keep sales going. So, EVs are becoming a tougher sell as we get to the past the luxury buyers who love them and into the mass market.
Yeah, well, that was certainly one of the weak spots here in those numbers. Not only a big miss on revenue, but that EBIT loss for that unit coming in bigger than what the street was looking for. David Welch, our Detroit bureau chief, helping us break down the earnings that are coming out of Ford. Stick with us. We're going to dive deeper into Intel's earnings after the break. This is The Close on Bloomberg. Welcome back to The Close here. A lot of earnings crossing the wire here in after hours trading, Scarlet. And the good news is that some of them appeared to be pretty good, at least based on the knee-jerk market reaction here. We hadn't had a chance to talk about Capital One, but there was a lot of concern about some of the credit card issuers and payment companies here. But Capital One holding up pretty well here, at least based on the numbers and at least based on the reaction in the market here, 4% gain.
Yeah, the charge-offs were lower than what analysts had anticipated, and on top of that, the company posted an increase in profit. So that was enough for investors to celebrate that stock, pushing it up by more than 3%.
I do have a question, Scarlet Fu. When was the last time you used a Groupon?
Honestly, I didn't even know that was still a publicly traded company.
Well, it is. It's only got a $350 million market cap. But look at that. The share is just surging here in after hours trading, Scarlet, on the back of some relatively interesting
Well, actually, you know what? We can answer that question. Thanks to our producer, Tim. Citadel Advisors has filed a 13G on Groupon. They have reported a passive stake in the company.
Oh, well, there you go here. And anyway, a lot moving here. A lot of companies out there, Scarlet, moving right now.
All right, let's get to some of the big high-profile earnings that have come out in the last 30 minutes or so. Let's get a roundup of exactly what we heard and go around the horn with Bloomberg's Abigail Doolittle, Jess Menton, and Emily Grafeo. Abigail, get us started.
Well, let's take a look at Amazon. Shares are rallying up about 3.5%. And it's interesting because it's a little bit of a mixed result, a mixed bag relative to results, I would say. So sales on the surface did beat 143 billion, was 1% better. The big number was earnings, adjusted earnings of about $1.40. That was 73% better on an operating margin of 7.8% versus 5.5% the estimate. So for once, this is one of the quarters where they did not sacrifice margins to invest. Investors probably liking that conservative guide because the cloud, there's a lot of pressure on that. That actually missed slightly. And in addition, the holiday guide, the sales, the lower end is well below consensus, suggesting that there could be a weak holiday there. I think one reason that the stock might be up in the after hours, though, is over the last couple of days, the last 2 weeks or so, it's on sale to the tune of 13%. So investors snapping this stock up right now, Jess.
And another one I'm taking a look at really closely, Abigail, is Chipotle. So if you look at that stock rising after hours, it's up around 5%. If you look at the one-day implied move there, it's supposed to be around 6.5%. So really this has been driven by comparable store sales coming in a lot stronger than expected, and especially just given that Chipotle actually just introduced some price hikes at its U.S. stores of about 3% there. If you look at its stock year to date, it's up more than 30% actually through today's close. So if you take a look at where the S&P 500 closed today, it's actually up 8% for the year. So clearly outpacing the broader market. But the question, how much longer can Chipotle and others continue to pass on costs? But another thing that analysts at Bloomberg Intelligence are keeping a close eye on is California actually recently passed some minimum wage hikes that are particularly supposed to impact this industry. So what are they going to say when it comes to executives on this earnings call? And then have to point out Chipotle is one of the top holdings when it comes to Bill Ackman. So will we hear anything from him, commentary from this company? But definitely keeping a close eye on that. But I know that Emily Grafeo is also keeping a close eye on Intel.
That's right, Jess. I'm taking a look at Intel, and the stock really popping here in the post-market. a lot of investors focusing on that upbeat earnings forecast for Intel. Fourth quarter adjusted EPS now forecasted at 44 cents, and that's versus estimates of 31 cents. And also adjusted revenue for the fourth quarter now will be, the company says, 14.6 billion to 15.6 billion, beating estimates there. Third quarter revenue and adjusted EPS for the third quarter also beat. The company really saying now that that historic slump in personal computer that was driven by a really buildup of inventory here seems to be over. The shareholders at least rewarding that right now, that positive forecast for the computing company Intel.
All right, 2,700 journalists and analysts under this roof here, and the best you just saw on this screen there are thanks to Emily, Jess Menton, and Abigail Doolittle. A nice roundup there. Let's continue our conversation about these earnings and about Intel. John Vinh joining us right now, Managing Director and Equity Research Analyst over at KeyBanc Capital Markets. This is the turnaround story, I guess, John, that everyone has been waiting for here. Do you think that what Pat Gelsinger has done so far has legs beyond today?
I think it's unclear. Certainly the results were pretty good. I think we're seeing a near-term improvement in PC demand. We think most of that is still being driven by restocking demand. If you think about the PC market, we're still contracting roughly about 12% today. I think the big kind of milestones that Pat has to show and Intel has to show going forward is really on foundry services and on AI, right? So they have announced that they have a prepaid customer, an Intel 18A. That is a pretty significant milestone. I think what investors are interested in hearing is just more color around that customer and how much volume potentially that customer is committed to Intel Foundry Services. And I think the story's still out on their AI strategy. Obviously, they've talked about some pretty encouraging benchmarks related to their latest Gaudi 2 AI processors, but they obviously don't have nearly the amount of revenues and scale of AI revenues that NVIDIA has right now.
Over the last couple of weeks, there's been a lot of speculation here about some of, I guess, it's lagging in that AI chip race here, and some moves, I guess, by other companies that seem over the long term would suggest that, I guess, the nucleus of this world has now firmly shifted away from Intel. Is there anything that they can do to maybe pull that nucleus back towards them?
I would say the investment in their Gaudi processor, right? The challenge with Intel right now is they're being impacted from two fronts, right? So as AI CapEx spend continues to increase, that's cannibalizing demand for traditional servers, which is the core of their DCAI business. And then secondly, to offset that, they really need to get a lot much more traction in their data center AI business. Right now, if I look at NVIDIA, they're on track to do potentially $80 billion in AI revenues next year. And, Intel has barely scratched the surface on their AI processor.
So when we look at the stock and how it's done, it's as of today, before we factor in today's trading, it's up 24%. And a lot of it was because it was seen as this beneficiary of the increased tensions between the U.S. and China. It's a domestic chip winner in that regard. Is that optimism justified?
We're sector weight, so we don't believe that is going to be justified from an overweight positioning perspective. Mm-hmm. But certainly the geopolitical trends certainly favor them, right? Obviously, a lot more companies are looking for geopolitical diversification in terms of their manufacturing footprint. And in terms of semiconductors, Intel is probably going to be your number one candidate. My concerns and skepticism is still whether they can actually execute on their foundry strategy. And we're waiting for a few more proof points there.
Also, they have plans to build a new plant in Israel as well. I believe there's a wafer fabrication. Is this something that will now be at risk because of the conflict in the Middle East?
Yeah, I mean, Israel has a really long, deep semiconductor industry from an R&D as well as a manufacturing footprint perspective. But I would imagine that given the conflict there, that those plans are likely going to be pulled back at some point.
When we talk about, you mentioned a little bit earlier here about this kind of, the next big customer that they're courting, and I guess in due time we'll find out just how real this has been here. But does one customer really change the narrative for this company?
I think it's a start, but to really get investors convinced and behind the story, I think they're going to have to follow up with several more potential customer announcements going forward.
Well, then that gets to the idea here, then, is what the value proposition. I mean, when Pat, or at least his deputies, go in there and they try to sell these companies on the virtues of choosing Intel versus their competitors here, I mean, what's the leg that he has to stand on where he can point to those competitors and say, no, not them?
Yeah, I mean, obviously, geopolitical risk, right? That becomes topical. And, obviously earlier this week with the increased China export restrictions, they kind of close down the rest of the loopholes in AI, right? His position only gets stronger. I certainly believe that, if you're a global semiconductor IDM, you're certainly going to take a very close look at Intel. And I think in most cases, you're certainly going to throw them a bone. You're going to give them some opportunity to kind of prove themselves. But I think it's going to take a long time before any company potentially gives them kind of a flagship product line and gives them kind of their core product line that, typically is going to be manufactured at TSMC these days.
So it'd have to be a courtship and a long-term investment. I want to ask you about gross margins because Intel indicated its adjusted gross margin will be 46.5% in the fourth quarter. That is better than what analysts were anticipating, which was 44.2%. You just contrast that with the kinds of gross margin numbers Intel used to post. At one point, it was well over 60%. Have those days passed and gone forever?
Yeah, we believe so. I think they're, seeing a number of different headwinds out there. Obviously the roadmap intensity, 5 nodes in 4 years, obviously is going to weigh on kind of gross margins as they continue to ramp their foundry business. It's likely going to be dilutive to their former long-term target of 60% gross margins plus. And then from a competitive perspective, they're seeing competition on multiple fronts. AMD is gaining share from them in the server business. And then, ARM processors are starting to ramp pretty meaningfully in the cloud data center. And that's also going to continue to add additional gross margin pressure for them as well.
And I believe Intel is also looking to slim down a little bit. It's sold some stakes in some businesses, spin off some others. Is this a company that's looking to streamline itself further and really concentrate its bet on data center and on foundry?
That would seem to be kind of where it's headed. We think those are clearly the right moves. The decisions to divest Mobileye last year and then more recently to divest their FPGA business, PSG makes a lot of sense to me, to really kind of focus on what their core businesses are, which is, foundry and obviously data center and compute makes a lot of sense to us. And I would expect more to come.
All right, John, great to catch up with you here. Closer look here at Intel surging here in after hours trading on the back of some relatively decent earnings here. We do want to go back, though, to Ford here, getting some additional clarity here on some of the issues going on right now with regards to it pulling its guidance here. Ford CFO now saying that the UAW strike has cost the company about $1.3 billion, saying it's adding about $850 to $900 in cost to each car here. He's talking with reporters here, and the interesting thing he's also saying, Scarlet, too, is this idea here that the strike-related costs in the quarter, most recent quarter, 3Q, was $100 million, which would suggest here, when it talks about the cost to the company of $1.3 billion, that a lot of this is going to show up here when we get the fourth quarter numbers in about 3 months.
Yeah, whether it's going to show up in one quarter or how they're going to parcel that out going forward is a big question. And also where else they can pull levers to perhaps reduce some costs, because they've got to look for that cost saving somewhere else now.
The company also saying that its margins have been reduced by about 60 to 70 basis points directly related to the UAW issues here, and the company saying that about 50,000 vehicles are on, quote, quality hold.
What does that mean?
Basically, that means that they were built, but the final inspections weren't done, primarily because folks were not there to do them. And so those vehicles are effectively sitting on the lot and have not been delivered to dealers here. So Ford, of course, has a lot that it has to sort out once it finally does ratify that contract. Coming up here on the close, we're going to focus in here on what's been going on with the crypto trial, the FTX trial, and Sam Bankman-Fried. We're going to get the latest after the break. This is Bloomberg. right, Amazon shares had rallied more than 3% here and after hours trading, giving all of that back right now and then some. On the conference call, Amazon CFO Brian Olsavsky said that consumers continue to be cautious. This might be actually what's contributing to the flip-flop. Scarlet, you actually kind of called this a little bit earlier here because the numbers on paper were very good. But of course, once you get those CEOs, CFOs on the conference call and start explaining the actual state of their business here, things can change on the dime here. So some relatively strong numbers for the third quarter, a relatively decent forecast going forward here, but commentary on the conference call suggesting maybe some potential softness in the consumer space.
Yeah, sounds familiar, right? This is similar to what we saw yesterday with Meta. So watch this space because we'll continue to keep you posted on those headlines from Amazon's conference call. Meantime, we need to get you up to date on what's been going on over in downtown Manhattan because Sam Bankman-Fried testified today in the high-profile fraud trial over the collapse of his crypto exchange, FTX. For more, let's bring in Pat Regnier. He is markets and finance editor for Bloomberg Businessweek. He is also the story editor of Bloomberg Original's new documentary, Ruin. Great to see you here, Pat. Congratulations on the doc. So what did we learn from Sam Bankman-Fried testifying today? What was his message?
Well, you had to tease it out a little bit. The judge sent the jury home before he began his testimony because the judge wants to decide if it's relevant. And a lot of the testimony focused on sort of the nature of the legal advice he was getting. So you have to kind of put two and two together. But what I think you're hearing is that he's making the case that like many of the key decisions I was making, I talked about it with my lawyers, and I understood the things I was doing to be allowable and within the rules.
They didn't stop me.
They didn't stop me. That's right.
Is that a legal defense?
It sounds like at least a defense.
It's an excuse, but is it a legal defense?
Right. I mean, the whole case has kind of turned on. All he's kind of got to say is that this money that was lost, this was a very terrible error. He's used the famous phrase, "I blank up," but it wasn't intentional, and I wasn't intentionally trying to defraud anyone. The nature of his defense is that this was all very complicated and it involved sort of loans between one entity and another, and that this was a mistake. And that's really in stark contrast to other top executives of FTX and Alameda who have already pled guilty and have painted a very different picture of the company.
That's interesting. And I'm not a lawyer. I don't think you're a lawyer, Scarlet,
no.
Last time I checked. But that seems like a pretty hollow, from a legal standpoint, a pretty hollow excuse. I mean, I was always told that just because you make a mistake doesn't mean it's not a crime.
Right. And there
are a lot of people in jail for making mistakes.
I wonder how much the judge is going to take that into account. This decision for Sam Bankman-Fried to testify, we're waiting up until the last minute to decide to hear whether he would do this or not. Do we expect what he's going to say to be all that different from what he said in the aftermath of the collapse of FTX before he was actually arrested? Because he was talking to everyone for a while.
Yeah. It's not sounding very different. Obviously he will, at this point, actually have lawyers next to him who may be stopping him from saying a little too much, as he's kind of famously said a lot on this topic. It's a I think a lot of this stuff really, and this is a constant in crypto, is like if I can make this complicated enough, maybe people begin to see it as more of here's a missing book over here, here's a missing book over there. And I think like the big question is, to your point, is at some point when you are entrusted with somebody's money, like there are mistakes and there are mistakes, and I'm even allowing for the possibility that this was an error. Even then, you have some responsibilities to not make those kinds of mistakes.
So just so we're clear,
that's a generous interpretation.
It is. Just to be clear, though, this is going to be the core of his defense.
This is what it's sounding like. The defense is just beginning, so we're all just watching and waiting to see what it was. But earlier, one of his lawyers said something along the lines of like, this company had no chief risk officer. So there was no one to stop us. This
company had no chief risk officer. The CEO who was appointed to kind of shepherd the collapse of this has basically said that that normally he comes in, he looks at the books of restructuring, and then he said there were no books to look at here. I just real quickly though, too, just to go back to the defense argument, if this is what they make. But that defense argument has to go up against some key witnesses who were close confidants to him that basically laid out in very meticulous detail, at least in their view, what they said Sam Bankman-Fried did wrong, and more importantly, produced hard evidence that seemed to back up their claims.
Yeah, I think he's. I'm not a lawyer either, but I think he has a pretty, tough story to tell.
But I mean, Law and Order's been on the air for like 30 years, so I think we all understand how the law is supposed to work.
Yeah. I mean, I think one of the things that gets clouded for people is, what he's accused of is taking money from his customers. The mechanical way that worked out was that Alameda borrowed money from FTX. And, that's an interesting distinction. And you can almost, the thing is that at a certain level, borrowing money is taking money.
Yeah, especially if you don't have the means to
say
pay
that
back.
he borrowed the money that he couldn't pay back is sort of just a way of explaining the mechanics of what it means to have taken the money.
Right.
and that's the situation.
Well, it's like that time I loaned my neighbor my snow shovel and he never gave it back.
There you go. So this is the criminal case. I'm certain that after this is all tied up, eventually, there's going to be civil cases against him, and maybe that defense of, I messed up and my lawyers didn't stop me. Will that work in a civil case?
Again, the one thing that you would have in a civil case is that, he's got a presumption of innocence, right? So one thing about this is that it is, in fact, the government that has to prove this. And
the burden
in a
is on
civil
the
case,
government.
the burden is going to be a lot different.
I see. Okay.
You were at the screening last night for, I'm calling it RUN, by the way, this documentary here. Is there going to be a sequel to this or some sort of addendum once we get the trials over?
Oh, I hope so.
Okay. Get out of here.
We've got to ask for the budget.
All right. We're going to, come on, guys. Don't be stingy. Everybody wants to know this story here. All right, stick with us. A lot more coverage coming up here on The Close, including setting you up for what to watch tomorrow. This is Bloomberg. All right, this has been a week of big tech earnings, but tomorrow we start to get some earnings out of big oil. Scarlet.
Yeah, Chevron and Exxon both reporting, and we have the ExxonMobil CEO coming on at 10:30 a.m. with Alex Steele, so stay tuned for that. But both of those companies making big acquisitions over the past couple of weeks, so we're definitely going to look for commentary on how they plan to integrate that.
And I also like this time of earnings season because you start to get into a better cross-section of the economy. We're going to get AutoNation, Colgate, Charter Communications, AbbVie tomorrow morning, as well as a few others.
Yeah, Black & Decker, CBRE, Lyondell, Basel, of course, the material side. So it's a good, as you said, read across the board of like what CEOs and management see going forward.
Well, yeah, that'll give us a nice read on the economy, but so too will the latest economic data, including that personal income and spending data.
I don't think this is going to move the Fed in any way, but it definitely buttresses the idea that the economy grew a lot faster than anyone expected in the third quarter.
It'll be interesting to see whether consumer spending is hold up in that personal spending data, but we also get the UMich sentiment data. That'll be interesting to read too, as how consumers feel about the economy.
And what they're thinking about in terms of inflation expectations, right? That's always a big component. And then, of course, you've got SBF on the stand, potentially again.
A lot for us to cover tomorrow. Scarlet and I will be back then. Balance of Power, that's coming up next. This is Bloomberg.